I think people are banking too much on the Fed being more modest.
We do think that we're still a long way off from the Fed really signaling any sort of even pause.
We're very close to the end of the hiking cycle, but we don't necessarily think we should be pricing in cuts for the European Central Bank, the Bank of Japan. They're behind the Fed. We've only just got to neutral in Europe.
We don't know if those rate cuts are going to come in 2023. We think it could be a 2024 issue.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Mr. Ferro in London after Tots Takeout Fulham. Lisa Abramowicz finally back from Switzerland. She was a shadow of herself yesterday.
Oh, come on.
And I'm here in New York as well. And what we know is we're not in this equity market, either are you, and that's going to be a big theme through the morning as well. It's a short squeeze. It's this, it's that, Lisa. The bottom line, equity market up.
How do you get faith that this is something sustainable, that this isn't just a head fake? And I think that that's really the question, especially as it's led by the riskiest assets, whether it's the emerging markets, whether it's Europe versus the U.S. It's a complete reversal of what we saw for most of last year.
A lot of thoughts on that. We'll talk on a global basis with Eric Robertson here in a moment. I'm going to go back to the legend that we had yesterday. No, not John Ferro. I'm going to go back to Ralph Encampora was with us, and he said, look, there was an October bottom. That's a lonely view from the technical legend.
I liked how you put technical analysis into its place, basically saying it is one piece of a puzzle. It's not the only piece.
Yes.
And that when you look at that piece, that momentum has lasting power. How does that fly in the face of all the gloom and the doom that still is pervasive underneath some of the temporary optimism that some people have?
The technicians will say that you can see the economics, the Fed babble, and all that through what you see in the charts. And right now, I'm going to say it's a boring January screen to the February 1 Fed meeting. Futures at -8 here. But Lisa, there's lots of incongruities here because we're coming out of a pandemic. China's opening, and there's just massive uncertainty around Ralph's October bottom.
Well, here's what I've been thinking about over the past 24 hours. European economic data has continued to surprise to the upside. Granted, the bar is as low as you could possibly imagine. In the U.S., it's the opposite. It's been disappointing on the margins a little bit more often, and you're starting to see a bit of a weakening, particularly with leading indicators. At what point can you see that divergence continue with Europe outperforming at a time when a lot of people were underinvested, right? That's always been the widowmaker. Is that really going to be perhaps the winner this year?
You know, I don't want to steal the thunder from your brief this morning, which we'll get to in a moment, folks. But the bottom line is there's a ton of economic data out there today, and the recession fears are tangible, yet they're really not yet in the statistics. I mean, that's the heart of the matter.
They're not yet. I mean, some people might say perhaps on Thursday we'll get that GDP number and we'll rethink that. But right now, you still see enough momentum, particularly in the labor market, because people still can get hired.
We're going to have to see on this. And again, February 1 is at Fed meeting. We're starting to piece together our Fed special. Is John back from London by then?
I don't know. I'll talk to my people. We'll have him talk to their people in Fulham. I like that it lasted all of like 5 seconds for you saying Fulham. Just
we watched it last night. We'll get to the soccer talk in a moment, but we drank the Ferro Kool-Aid. I mean, that's all there is to it.
We drank the Ferro Tang.
2 years ago, 3 years ago, you and I would be like, what? And there we were watching Harry Kane score one magical goal. Let me do a data check right now. Lisa will have the brief for you. Futures -9, Dow futures -71. The VIX under 20 for a bit, 20.03 right now, off that strong market yesterday, off that strong market Friday. I like what Zero Hedge said, just a massive short squeeze out there as people exit the gloom as best they can. BitDog 23,000, I point out. And we're both watching oil. Brent crude 88.17. Yeah, it's pulled back, but just fractionally, and that gets us to be briefed on a Tuesday.
Yeah, especially with that oil price going up. At what point do you start to see that percolate, that optimism percolate into some of the other instruments out there, commodities and beyond? 9:45 a.m. This is the key data point that I'm watching today. U.S. S&P Global U.S. Manufacturing, U.S. Services, and Composite PMIs for the month of January. Earlier this morning, we got some data out of Europe, and it was much better than expected. The private sector growing at a faster clip than people had expected. Do we see the same thing in U.S. services? We have seen it decline, where you have seen a retracement.
9:45.
That, to me, is going to be interesting. 1 p.m., the U.S. is selling $42 billion of two-year notes.
Thank God.
We've seen the two-year yield off its earlier peak. There is a dissonance that continues in markets with people not having faith the Fed is going to really go through with what they're saying, which is go to 5% and hold it. And yet at the same time, the Fed keeps doubling down on that.
And now for the dumb question of the morning. I'm in charge. Surveillance model. Who buys the auction? They're going to sell it.
That's a great question.
Who do they buy it? Who buys it?
So traditionally, it was the dealers. The primary dealers were responsible for taking down a certain number, a certain proportion, or anything that wasn't sold to independent buyers, to institutional investors. But they have taken on a smaller and smaller chunk, as a lot of institutional investors have been playing in these auctions. Okay. Also, aftermarket, Microsoft and Texas Instruments are among 18 companies that were reporting today. These companies aftermarket. Microsoft, how much cloud computing are people still investing in? That is really what I'm going to be looking at, because that's one of the reasons why this stock has underperformed as much as it has, Tom.
Right now, let's get to it. A global conversation with Global Head of Research at Standard Chartered. Eric Robertson joins us now from Dubai on the greater force of EM and international investment. Is it legit this time, Eric? Is it really the moment for EM and international equities?
It's a good question, Tom, and good morning to you guys. Look, one of the things we learned coming out of the global financial crisis was that when markets started to recover after March 2009, it was those assets which had been beaten down the most over the previous few years which recovered the most aggressively. And we're seeing a repeat of that today. It's emerging market equities, it's emerging market currencies, it's credit. And look, it doesn't necessarily require a lot from the central banks, but perhaps just to stop hiking and to take away some of that monetary tightening risk and the easing of financial conditions that brings with it. So I think there's an element of short covering, but also an element of people just getting back some risk on their books.
Tell me about the dollar dynamic at Standard Chartered. You are so advantaged by your foreign exchange team. Do you believe in a persistently weak dollar as an overlay for equity markets globally?
I think that's right. We do believe that last year the dollar put in a medium-term peak. I suppose what I would observe is that we've already unwound about 75% of last year's dollar gains. So we've done quite a bit of normalization very, very quickly, Tom. I think in the very short term, the dollar probably consolidates those losses, and some of the foreign currencies that have recovered quickly probably stabilize. But over the medium term, as the Fed stops hiking and financial conditions ease, we do expect investors and other participants to allocate a larger share towards foreign exchange.
How much of the European bet that so many people seem to be doubling down on really is tied to China's reopening?
I think it's a part of the story, Lisa, and I think it's a good point. But you also made a point earlier in the show in the sense that people have been structurally underweight European assets. People have been structurally of the view that Europe would underperform economically. And as we're seeing now, we're seeing upside surprises in the data. This feared recession, the food and energy crisis, which was so talked about last year, is just turning out to be less threatening than expected. And so I think there's a very good case for Europe to at least outperform some of those really downbeat expectations as we come through a more mild winter and a reallocation of those assets, as you guys described earlier.
We're just seeing right now a headline across the terminal that Germany is set to forecast economic growth of 0.2% this year, which I find compelling considering that so many people were expecting recession.
This is Camille Kamaros. This is Bloomberg reporting on data to be reported tomorrow. This is an early report where perhaps it's leaked out. I'm not going to say that, but we're positing it that Wednesday we will see out of Germany that 0.2% annual inflation, which is a little bit better to grow by 0.2% versus a contraction rather of 0.4%.
Which raises a question how much further things can go. And I'm wondering how much this is expressed in the euro. How much can we see, 115, 120, Eric, on a euro versus a dollar back to levels that nobody thought was even possible because of the strength there. And on the flip side, the U.S. kind of passed the peak in certain levels.
Look, I think that's right. I'd be a little bit cautious with levels around 120 or above in the euro. I think that makes some very generous assumptions about the trajectory of their recovery when it comes. But you mentioned China earlier. We have an above consensus view on China GDP for this year of 5.8%. But most of that escape velocity in their economy is going to come in the second half of the year. So I think for Europe, it will be a slow and steady recovery. But as you guys correctly pointed out, just beating those very downbeat expectations may be enough to bring capital back.
You know, Eric, I look at it in the sophomoric way to look at this is it's a zero-sum game. If China goes up, we go down. I don't buy it. And the basic idea is if we get a 5.8% China recovery, if we get a lift of the Pacific Rim, where your Standard Charter expertise is, that's got to lift all boats to a first order, right?
Absolutely, Tom. And I'll take it from two different angles. The first of which is that ASEAN, so Southeast Asia, is expected to grow 5% this year. If you've got ASEAN at 5%, China at 5.8%, that's going to lift a lot of economic sentiment around the world. And I agree with you. It's not a zero-sum game. If China and ASEAN are improving, India is improving, that should ultimately help the recovery in global trade as well. And I think that will be a net positive for the West.
Eric, thank you so much. Eric Robertson from Dubai. He is with the Standard Charter Bank. Lisa, this is really important. Again, I want to reframe this, folks, so we're careful. Bloomberg reports a day ahead of time. According to people familiar, the German economic statistics will get those official data from the government tomorrow. But what's important here that Mr. Robertson talked about is flipping from a negative statistic on a monthly basis or annual, whatever, to a positive statistic. To go from the word contracted to the word grow is not a small matter.
But if you read a little bit further, are we just taking away some of the growth from the next year, right? I mean, this is basically interesting to me. No, honestly, how much is this basically saying, okay, perhaps Germany will grow a little bit this year, but it will grow less the following year than previously expected? Because that seems to be what this forecast is saying. Because if you get the dynamism now, do you get the real reduction in inflation and the conviction to really fight that in the same kind of way?
I'm not going to crystal ball gaze this because as a matter to their southeast, southeast, whatever, they got a war going on. And I'm just not, I just can't go to the crystal ball gazing. And importantly, who cares what I think? I don't think the ECB can go to crystal ball gazing. They're going to look at the facts as they're displayed. What's a disinflationary tendency?
I get your point. Making a prediction right now, very difficult, but that is what the German government, at least according to this report, is expected to do, to downgrade its growth forecast for 2024 while upgrading the forecast for this year.
Again, Bloomberg reports a shift in Germany from contraction to maybe some optimistic growth. Stay with us. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Poland has formally requested Germany's permission to send its German-made Leopard tanks to Ukraine. That comes after weeks of pressuring Germany's Chancellor Olaf Scholz to drop his cautious approach to delivering the tanks. German law requires approval for the re-export of military equipment. Bloomberg's learned the U.S. Justice Department is set to sue Google as early as today. The case has to do with the search giant's dominance over the digital advertising market. Google controls most of the technology used to buy, sell, and serve online advertising. The company has argued that the market is a crowded and competitive one. In the UK, there's more evidence that the economy probably has slipped into a recession. British companies signal that output has dropped at the fastest pace since the start of the pandemic. Meanwhile, the government's budget deficit rose to a record. Soaring interest rates have jacked up the cost of debt service. In Half Moon Bay, California, police arrested the suspect in another mass shooting. 7 people were killed and 1 was wounded at 2 plant nurseries. The 67-year-old suspect was believed to have been a worker at one of the locations. Meanwhile, an 11th person has now died from the shooting at a dance hall in the suburban Los Angeles. That suspect in the shooting killed himself. And Twitter has been hit with 2 lawsuits for not paying rent. According to filing by its landlord in San Francisco, the social media company failed to pay the more than $3 million monthly rent for December and January. In the UK, the Crown Estate, which is owned by the British monarch, filed a suit against Twitter over its London location in the West End. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
We do not have different rules for Democrats or Republicans, different rules for the powerful and powerless, different rules for the rich or for the poor. We apply the facts and the law in each case in a neutral, nonpartisan manner. That is what we always do, and that is what we do in the manners that you're referring to.
He has been more quiet than the average Attorney General. Merrick Garland is your United States Attorney General, speaking there on, I believe, documents and the treatment to be had moving forward. Right now, and for all of you worldwide, we revisit what we've revisited in America is revisit death. The governor of California simply calls it tragedy upon tragedy. And what I've noticed with Anne-Marie Horton in Washington is she and I have perused the papers, we've listened to the politicians, and basically, Anne-Marie Horton, thoughts and prayers are out the window. Nobody's talking about thoughts. Nobody's talking about prayers. We've had multiple mass killings in hours. Maybe you measure it days. They happen to be of an Asian persuasion. It's one and all the same. Where's the bipartisan support to do something like there's bipartisan support to do something about China?
It's just not there, Tom. I mean, the House in the previous Congress did pass a bill which was looking at more gun control, but they didn't have the votes in the Senate. And we spoke to Congressman Ro Khanna of California yesterday, and I asked him about these shootings. And until you have this bipartisan support, like you're asking for, there's not going to be any big movement when it comes to guns in the United States. And that's where it is right now. I'm not really sure how much more the pressure could be. You had Uvalde shooting, recently.
Right.
That was last year when children were killed in elementary school. You had last night 2 shootings in Northern California on the heels of a ballroom shooting. And as you say, these is Asian Americans. They were, especially Chinese Americans. They were celebrating
Right.
Lunar New Year. And this is all you're hearing from politicians, our thoughts and our prayers, but there really doesn't
Right.
seem to be any action on how do you change this culture in America.
Troubled individuals seem to be geographically spread out and also politically spread out. I believe we could suggest California rather has low Republican registration. Maybe it's a more Democratic tilting state. In Washington, how do they synthesize a shooting in California versus a shooting where Trump won by 20 points in the South? What's the difference?
Well, I think it gets to what I just said, this idea of gun culture, mass shootings. This happens in America regardless of political affiliations. I think also in California, there's a lot of questions about, the weapon, at least certainly what I know, the weapon that was used in the ballroom shooting, that kind of weapon is banned in California. So this is really troubling for individuals in California who feel like they've made progress. But clearly, obviously, nothing will change unless it's federal.
It's a delicate conversation. As usual, Anne-Marie Horton is prepared and really gives us perspective. I did that, Lisa, for our international audience, because in my travels worldwide, what I've noticed is people are just stunned by the uniqueness of this in America.
I think we're all stunned at the uniqueness, if you want to say that. It's a tragedy for sure. At a time when there seems to be some sort of stasis in Washington, and Anne-Marie, I am curious about that stasis at a time when we're talking about the debt ceiling, we're talking about a fiscal impulse. What kind of pushback are we getting? What kind of intel in terms of what cuts are required to get the government functioning once again and eliminate the debt ceiling from some of the strain?
Well, Lisa, it depends who you ask, right? Because the Democrats say there will be no spending cuts in terms of they don't want to be held hostage to spending cuts to raise the debt ceiling. Well, with the Republicans, they definitely want spending cuts. They want to take a look at the budget. They want to keep the next fiscal year capped at the previous fiscal year. They want $130 billion shaved off the budget. The question you're asking is a good one. Where does that come from? And this is something that Republicans even are debating amongst themselves. But we did see during the rally of the speaker vote that one of the things that was on the table, even being discussed, was even potentially cuts in defense budget. So it does seem like all spending is on the table that Republicans want to look at in terms of cuts.
What is bipartisan in terms of a good area to cut? Is there a sense that there are areas that do have fat to trim?
I'm not really sure, because at this point, there's so much spending that individual groups are rallying behind. I'm not sure there's one issue that could be bipartisan at this moment, because everything feels very partisan in Washington, right? Even defense, maybe that could be one if Democrats and Republicans were able to look a little bit deeper, because for a while there's always Democrats who, long-term mantras, Democrats are the one that want to cut defense spending, put it more towards domestic. Now you have Republicans even looking at it, but it's a very difficult time to be discussing defense spending when the United States is sending military aid to Ukraine. So even that moment in time, you'd think in the past, maybe defense could be an area. It doesn't look like it.
Anne-Marie, thank you so much. Greatly appreciate it. In Washington, Anne-Marie Horton, our chief Washington correspondent, also ensconced at the White House. We don't look at GE the way we used to look at GE, do we?
Well, it got broken up, and it has a very different kind of picture. But right now, they just reported earnings, and it came in disappointing. They expect the adjusted EPS for 2023 at $1.60 to $2 versus the estimate of $2.37. So you can see the reaction in shares. They are down 1.5%. But it raises questions to me about how much you're going to see an ongoing bifurcation with the manufacturing side continuing to be in the slump that we've seen for a bunch of months now versus services that still chug along, right? I mean, we continue to see certain companies and businesses, particularly the airlines, that do well. How much does this diverge, and how much does it converge with people going to the industrial side?
I would not take too much into this, in that it's very, very clumsy right now. They're spinning off this, spinning off that. There's 3 units. They're going to be 3 separate companies. Whatever, the strategic vision is here. It's a stream of headlines, some very disappointing, including 160 to 2 versus an estimated 237. But I'm going to suggest the level of noise in this earnings report is off the chart.
I would agree with that. $400 million of separation costs in the quarter that they announced, to give you a sense of what we're looking at. You also are looking at the expectation of high single-digit revenue growth in this year. Is that good enough revenue growth at a time when costs are increasing? I'm curious, as we dig through some of the earnings, not just of GE, but more broadly of other companies, the 18 that report of the S&P today, how much you start to see that margin compression versus some plateauing after last year. Right. We saw companies kind of bake that in a little bit.
Lawrence Culp has done this before, of course, with Danaher, and he's now the CEO and chairman of General Electric, and he notes aerospace with a very, very nice lift, solid revenue growth, power, double-digit growth. I think that's a little better than expected as well. But the level of noise here, this is not CFA 101 with GE. This is tear a company apart and put it together again. And to William Cohan's magisterial book on the collapse of GE, what this is really about, Lisa, is a company that doesn't have the presumed financial stability of GE Finance that was that wonderful keel, if you will, on the boat years ago.
The reason why I diverted to this idea of where the technology, the industrial complex was going to be is because we're about to get Raytheon Technologies and Halliburton among the companies that are reporting earnings ahead of the opening bell today. How much do we see some sort of similar softness versus the opposite, right? The opposite story, especially as people invest so much in the conflict in Europe and beyond.
Earnings out, Microsoft later today. We are into that interesting season. Of course, technology earnings coming up, wrapped around Fed Day, February 1, February 2, and such. Futures deteriorate -7. S&P futures down -11. Please stay with us from New York, from London. John Ferro in London with Simon French. This is Bloomberg. Bloomberg Surveillance. Good morning, everyone. Lisa Abramowicz and Tom Keene in New York. John Ferro in moments from London with Simon French. Really looking forward to that. Earnings Derby is on. What we're going to do is try to find the ones that speak to the underlying economics and the path forward for the nation. And you can do that with Johnson & Johnson out with their earnings. Lisa's been killing it on them. And I'm going to bring up, Lisa, that this is the first real earnings report I've seen where we had strong dollar, foreign exchange adjustment, and now what in Q1 of a weaker dollar? So there's going to be a whipsaw here down the income statement as you adjust for dollar dynamics for multinationals, make up a huge part of American business.
What stands out to me is the resilience here, despite some of that volatility. They said that the decline that you saw in the fourth quarter sales were driven by that foreign exchange adjustment that you're talking about, as well as reduced COVID vaccine sales, but still expecting earnings per share to come in above estimates. So this, to me, is interesting. If you look at each particular segment, you could see one by one trying to offset one another. But R&D expenses, this stands out to me. Expenses are going down. They came in below the expectation. And marketing, selling, and administrative expenses also came in below the estimate, albeit marginally. But this is an issue of cutting expenses, and we've seen that across the board.
Q4, the last 90 days, and this goes to Gina Martin-Adams' conversation yesterday. Sales come in a little bit light. I'm not going to make too much of that about a multi-division, multinational. But with disinflation, as Phil Correa, pioneer, said years ago, the bright lights of inflation create revenue. So if there's disinflation, the lights aren't as bright, I think, is how you circle that.
Right. How much can they not basically raise prices as much?
Yeah.
At the same time, can they cut costs perhaps a bit more because there's less pressure? And are we starting to see that around the margins?
I think we're going to see it. The history of these slowdowns is it's not just tech and not just banking. We're going to see cost cutting. It's, it can be
on
1%
the
and
margins.
2% on the margin.
Yeah, but that's exactly R&D expenses, $3.84 billion versus the estimate of $4.12 billion. This isn't, catastrophic.
Yeah.
But it's there.
For those of you on radio, J&J with a little bit of a lift up a stick here, and I call it 0.5% right now. We'll monitor that. Futures -7, Dow, they deteriorate, -13 now. Dow futures, we do for John Farrow, -86.
He thanks you.
The VIX, 20.10. Oil, 88.26. And we've got to do sterling for John, 123.14. He loaded up on the swag last night at Fulham.
It's
loaded
the opposite.
up.
He's paid in dollars. Anyway.
I don't understand that. Joining us from London right now in an important conversation, John Farrow joins us this morning. John, how are you?
I was just asking the floor manager, Tom, if it's too late to unclip the mic and walk away. Is it too late?
You've done that before.
We're live on air now.
I can understand.
I have.
Good morning.
I have.
Good morning.
Good morning to you. We get lucky this morning. Simon French, chief economist at Panmure Gordon, joins us. The number of the morning here in London, a little more than 27 billion sterling. That's the budget deficit for the month of December. That's a record for the month, Simon. Should I be concerned about that?
If you think RPI, which is the retail price index, the rate of inflation by which a quarter of government debt is indexed, so about £600 billion worth of UK gilts are indexed to the RPI, running at 13%. If you think it's going to stay there, get worried by that number. If, however, and we've got a note out this morning looking at the pathway now for both RPI, CPI, the Consumer Price Index, if you think that's going to fall pretty dramatically, then this is a, dare I use the word, this is a transitory problem.
Well, you've used the word.
I have, because in the context of servicing the government debt, particularly the aspect that drove this morning's data, the RPI coupon, it is going to fall away quite dramatically by this time next year.
It comes at a time where the public sector is asking for a pay rise, going on strike. Ambulance workers started yesterday. Are they going to get that pay rise?
They are, but they're not going to get one that keeps pace with the rate of inflation. So largely asking across the blue light services for more than 10%, keeping in pace with RPI, CPI. What the strategy here is from the UK Treasury is multi-year settlements. Multi-year settlements that try and smooth the one-off impact of providing a potential wage price spiral stimulus with a 10, 12, 13, 15% increase by saying potentially 444, 555, a multi-year settlement that recognises that we will be in a very different inflationary environment in 24, 25, and actually, if you like, buying off the smoothing of that underlying inflationary pressure through a multi-year settlement.
Looking at the PMIs this morning, Eurozone PMI, the composite, I believe that's the first above 50 reading going all the way back to June. You've got the German government coming out tomorrow releasing economic projections. We're reporting that that could be positive for the year 2023. There is a hope, a conviction maybe of your Chancellor Scholz that Germany can escape recession. Can we have that same confidence here in the UK?
Yes, we can have confidence that it can, albeit for the same reasons that very bearish consensus was put in place for the UK back in November. Those factors haven't been entirely eliminated. They're put in place from the Bank of England, who update the market next Thursday with their own growth forecasts. Bear in mind, back in November, they saw 8 successive quarters of contraction. That isn't a recession. That is the longest recession projected by the bank in post-World War II history in the UK. Are they going to upgrade from that position? Yes. I think they will still, trying to sort of look into my crystal ball of what the Monetary Policy Committee will come up with, they'll still see a recession, but much shorter and probably much shallower. Why? Because they conditioned their forecast back in November on a gas price twice the level of the gas price, the forward curve today. That makes all the marginal pricing in wholesale markets for UK energy, feeds through to real income squeezes. Yes, we can avoid the recession, but look, events 2,000 miles to the east in Ukraine will dictate whether that curve continues and whether we may be back having this conversation at the start of May when the bank update again, and the curve has moved again. So it'll be a moving feast. Investors need to stay ahead of that.
Well, let's talk about bank rate just around the corner, across the road over at Threadneedle Street.
Yeah.
Back at the end of last year, when things were going a little bit crazy, September, October time, market pricing for Bank of England rates got to about 6%, a six handle. Governor Bailey pushed back against that. We're now at about 4.5.
Yeah.
Governor Bailey is not pushing back against that. Now, do I take that as an endorsement or just Governor Bailey not talking about interest rates?
It's an endorsement. Not an explicit endorsement, but an implicit endorsement. The Bank of England were pretty open, weren't they, back in November? They didn't agree with the conditional curve that they put into their inflation forecast. That, they will say, is why they can have some credibility going back to the market in February, saying, look, a different market path now, one we're more happy with, therefore a more realistic growth forecast. My challenge, I put this in my notes to investors at the time, is I said, look, it's all very well conditioning on the market path, but if you don't believe it, the debate over whether we should actually be conditioning on a dot plot based on what the MPC believe, as the Fed do, is probably a conversation we should have again, particularly if it frames expectations, investment decisions, both in terms of capex, corporate incentives to borrow. They're framed by what the Bank of England say. Whether they should or not is perhaps a second-order question, but they are, and therefore going back to the market in February with a more realistic assessment of where the economy is going and where bank rates are going is a welcome thing. Maybe the damage, though, has already been done.
You mentioned a dot plot over at the Federal Reserve, so let's discuss that. There is a spread between what they're projecting and what this market thinks is going to happen.
Yes.
Where are you on that side of the debate right now?
I'm with the Fed. They're the ones who make the decision.
You think they get through 5?
Yeah, I do.
What's going to take it there? Inflation being too sticky?
Core inflation. So I look most relevantly, I think, at the elements of the core inflation picture, both wages and rents, that I think are going to remain pretty stubborn. The part, actually, of the dot plot that I think is worthy of far more debate, I'm not telling you where to take this interview, but I think the long-term assessment of where the terminal rate, the R-star is for the US economy, is painfully too low at 2.5%. The real market move here is when the Fed, throughout the course of this year, start to ramp that up. It's always been a bit of a moving feast going with what the market can absorb, but that's where the big move comes rather than the front end where it sees the pathway over the next few meetings.
I'm super happy to go there, so let's go there. Deutsche Bank is projecting, once we do peak, we'll get 200 basis points worth of cuts, maybe through 2024. That long-term dot, where do you see it coming up to? Where does it belong?
Probably 100 basis points higher than where we are at the moment. Yes, you could argue I'm sort of hedging my bet sitting in the middle. But look, 2.5% in a world with very little of the disruptive forces pricing power that has now been introduced in large parts of the corporate sector, the real move, the legacy of the pandemic to shorten supply chains, resilience, security, that would all suggest structural forces moving up the long-term R-star rate, not just in the United States, but actually, and I think we spoke, didn't we, on the show last week about what that's doing to the equilibrium interest rate in the Eurozone. These are pan-continental forces that are pushing up the neutral rate. 100 basis points is probably about where I think the Fed will end with their long-term assessment by the end of the year, but they've got to go on that journey by feeding it to the market.
Regime change.
Yeah.
When you have this conversation with clients, is that a view that's appreciated or a view that gets pushed back on?
Healthy scepticism.
Still?
Yes, of course. I think everyone can understand the qualitative narrative around a higher R-star.
Yeah.
But you've got to start to see that. And there's been some healthy debate, I think there was in Davos last week, about whether deglobalization is actually happening or whether it's something that is easy to talk about. But actually, when you start to delve into the data, actually, supply chains aren't shortening quite as much as perhaps the narrative suggests. Healthy skepticism. This is why, the danger of myself sounding like a central banker, you need to be data dependent. You need to see whether these dynamics actually play out, not just on the basis of sell-side research and the notes that we pump out, but actually in the real economy.
Can I squeeze this one in?
Yeah.
I've asked this question twice already this week, so this is 3. I'm 2 for 2. Let's see if we make it 3 for 3. The ECB versus the Federal Reserve. Who hikes more this year?
ECB.
The ECB, 3 for 3. Simon French of Panmure Gordon. Thank you, sir. It's good to see you. TK, that is 3 people. 3 people I've asked over the last 24 hours who hikes more this year. All 3.
Yeah, John,
all 3 have said the ECB.
I'm glad you're asking this question. And to me, you know where I'm going to go with this. It goes back to nominal GDP. And I just don't see, with war, without war, how ECB can do that. It just doesn't commute in my brain. I mean, it's all there is to it.
I hear the same thing. But to Simon's point, Tom, we haven't got a crystal ball. We don't know where the economy is going. But relatively speaking, it's better now than it was 3 months ago. And we're going to see that reflected in the projections from the German government tomorrow, I expect, based on our reporting.
New high in the Bloomberg Financial Conditions Index, new accommodation, John, in the United States, and still remarkably restrictive environment in Europe. There's a massive distinction off that important set of data. No question about it. John Ferro will continue in London with us through the morning and, of course, through the week as well. It is a company from the past, and if you're an ancient fossil, well, there's a little difference. With Minnesota manufacturing and mining, it is 3M and Lisa Abramowicz. It's been a beleaguered decade of a 6% total return. This is not the Minnesota mining of my youth.
3M shares down by about 3.5% after missing the forecast for this year for the adjusted earnings per share. Talking about cost cuts, talking about ongoing macroeconomic uncertainty. How much is that going to be the theme in a lot of the earnings we see?
Even for blue chip, Dow Jones-like companies, John Ferro knows that, there can be times of angst. There's been a decade of angst for 3M. Stay with us on Earnings Microsoft this afternoon. Futures at -9. From London, from New York, this is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. New tensions between the U.S. and China. Bloomberg's learned the Biden administration has confronted Beijing over state-owned companies that may be helping Russia's war effort in Ukraine. The Biden team sees evidence of non-lethal aid being sent to the Kremlin. No one involved is commenting. In Finland, the foreign minister says the government may need to reconsider whether to move jointly with Sweden toward membership in NATO. That's after Turkey's President Recep Tayyip Erdogan raised new objections to Sweden. Finnish Foreign Minister Pekka Haavisto says the primary option is for the two countries to join NATO together. In the UK, the Labour Party would work more closely with the European Union as part of a reset of its foreign policy. Labour's shadow Foreign Secretary David Lammy will outline the plan today. Some polls suggest Labour could win the next general election. The FBI says that hacking groups linked to North Korea stole $100 million in cryptocurrency last year. According to investigators, the hackers targeted the U.S.-based blockchain specialist Harmony's Horizon Bridge. Now, Horizon is software that allows crypto tokens to move between different blockchains. Those bridges became a target for hackers last year. And Bloomberg's learned that the digital asset firm Gemini Trust is eliminating another 10% of its workforce. The company, founded by the billionaire Winklevoss twins, remains pressured by a months-long industry slump. Gemini fired 10% of its staff last June after crypto prices plunged. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
We are still very much focusing on employment and earnings. I think those are the obvious benchmarks. We are very, very close to the end game here. But I think that the other issue that we would still take issue with from the market perspective is that degree of cuts, that rate cutting that's priced into the market.
Jeremy Strauss with John Ferro in London, really on topic yesterday, and of course a lot of European dynamics there as well. We're going to continue that discussion here in a moment. Right now in earnings, Lisa Abramowicz and I sorting through it all. And to me, Lisa, and I mentioned this to Gina yesterday, to me it's all about a softer revenue line. For the last 12 months, we've had the shock of maybe an organic company of 5 or 6% revenue growth delivering 8 or 9% revenue growth, and that makes everybody feel good. It's gone.
Well, and that depends on the industry, of course, and yet we're seeing it broaden out. How much are you going to start to see the cuts really be the theme of this particular earnings season? We've already seen it with 3M. Even on the margins, J&J beat their estimate and their expectation for this year, and yet still they also are cutting back. We also got Raytheon Technologies. Interesting when we talk about defense budgets, and they actually beat expectations, although for going forward, maybe not necessarily. So honestly, even in every single segment, it's a sort of motley picture that we're getting
motley picture. It's a toxic brew and a motley picture. Joining us right now, again, John Ferro in London, Lisa Abramowicz and Tom Keene in New York, to speak of the dollar. And as he well knows, it's not about up or down. It's about the times where you pause. Mark McCormick Jones is Global Head of Foreign Exchange Strategy, TD Securities. This isn't one financial media likes to talk about. We want dollar strong, dollar weaker, makes for good ratings. Then there's dollar pause. Is that where we are now?
Yeah, I think we're in a bit of a dollar consolidation period. I think we got the big move that we've had since last year. I think a big part of it really has to do with the drop in the rate of change of inflation. The thing that we don't have is global growth. You're just mentioning earnings. If you look at like kind of earnings expectations or earnings surprises relative to risk should be a little bit more off, and earnings should be higher. So I think in that context, when you think about the dollar, it priced out a huge part of the stagflation premium that was lingering in it towards the end of last year. But now we need to see growth delivered to get us another leg lower in the dollar. So it is about stabilization right now.
Walk us through the earnings that we're seeing right now, and particularly multinationals. And folks, I don't have the number in my head, but multinationals in America, I'm going to say 30-40% of their pie is abroad. Okay, as a general statement, that means they're dollar dynamic. What did the massively strong dollar do to those kind of American companies last year?
Yeah, it has a negative impact, just like it would on equities. So the stronger dollar, basically, the earnings that they have to bring back are lower because the euro was weaker, and then therefore they're reporting weaker earnings. So the dollar also has a negative impact on earnings, as long as it has a negative impact on growth, just like it has a negative impact on commodities when the dollar's stronger. So all those things are partly going in reverse, but we have not seen kind of the change in expectations around earning that would calibrate it to the type of risk sentiment and optimism we have in markets right now.
I'm still trying to get over, Tom. Basically, you saying that it really makes for great ratings if you say the dollar's going to go up or the dollar's going to go down. This is pretty much pretty specific.
It's the Democrats' fault. It's the Republicans' fault.
Audience. But I am wondering, Mark, is there a linearity to the dollar trade this year, or is it just chop, right? And people talk about this linearity right now of the euro gaining at the expense of the dollar because of the diverging fates. Do you buy that story?
It's a great question because I think we're out of the linear moves in FX. I think a part of it is we're very, very bearish for the dollar for Q2 and Q3. While I'm mentioning right now a bit of consolidation, I think what we're saying over the next month, most of our models that are macro-based tell us the dollar should be about 2% stronger. That's how we get back to the growth story. But in Q2, Q3, we start to see the front loading of a better global economy, a slowing U.S. economy, a Fed that's basically moving on hold, an ECB, BOJ that are more hawkish than the Fed, and basically China reopening starts to matter because the rest of the world's accelerating, yield curves are steepening, U.S. yield curve is flat. So that is front loaded, and I guess it feels nonlinear because we have euro basically going to 115. And then we have euro basically settling around 112. By Q4, though, what will matter is that we don't think the Fed's going to be cutting this year.
Right.
We also think inflation is going to be sticky. But right now we're trading the delta of inflation. So inflation's coming off, markets are getting like more optimistic. But on the downside of this, towards the end of this year, things are probably going to be a little bit stickier in terms of the levels of inflation. You can already see it in core. So I think part of it is the linearities are gone. And we're kind of dealing with smaller cycles that will be bigger and more volatile, especially in the macro space for at least the next year.
We were talking about that last year, though, and how some of the drivers traditionally that people followed in the foreign exchange market, like central bank differentials and who was moving first and bigger and better, were kind of breaking down, and it was the economic trajectory. Although now people are painting the same story, that the Fed, as John's been asking all of his guests, the Fed is probably going to hike less than the ECB this year, right, and that the European scenario seems to be a lot better. How much is that enough to get beyond that 112, beyond that 115 in the euro?
So there's a point to it as well that the macro volatilities here, it's just the factors driving it are different from this year to last year. Last year was about carry. in US dollar space. It was about momentum. You have not seen a momentum model make money in FX in years. It was the first time you're getting really good Sharpe ratios trading momentum. And then also the inflation momentum itself as a macro factor was in the US. All those things have changed. So if you take away part of the inflation, the thing that matters most is value. So the underlying thing that's going to drive FX, I think, that still carries over from 2022 to this year and even next year is commodities. So terms of trade momentum, the countries that are exporters, the countries that are importers. The problem is the momentum is flipped. European terms of trade is better. That's what's feeding the growth story. Your Japanese terms of trade is better. Korean terms of trade are better. So the Asian cycle is better because the cost of things that they're importing is getting cheaper. So therefore, like the constant driver in FX will be terms of trade and commodities. But now we are trading the extreme overvaluation of the dollar. That's very bullish for emerging markets. It's very bullish for equities outside the U.S.
John emails in from London, and thanks for watching today, John. Really appreciate that. John emails in and says he's looking in Chelsea SW3 at 10.5 million pounds. It's a little small brick thing with a Jaguar out front. It was sterling. I mean, which way does this cut for a guy who can choose whether he's paid in sterling or dollar?
That's going to be the interesting part with sterling. The way we look at it is I feel like every region has currencies and they're kind of tiered. In Europe, G10, Euro's top tier for this year. Swissie's probably second tier. Sterling, stocky, NOK, third tier.
What does that mean, third tier?
They're going to be less attractive.
I don't want to be seen with them?
Yeah, you don't want to be seen with them. Maybe in front of the 10 million pound flat. But
some of my children are third tier. Be careful.
Yeah. Well, I have 2 tiers for my 2 kids. One is bad. But essentially, like for sterling, the way that we would kind of think about it, it does have massive stagflationary risks. The thing that's actually very interesting, though, is that it's highly correlated with risk itself. So the way that we're kind of characterizing the world is that as things improve in Q2, Q3, euro outperforms sterling because euro's closer to China. But on a big dollar down move, sterling's going to go up largely because U.S. dollar's going down and risk assets are rising. So I think at that point, euro sterling goes through 90, but sterling's outperforming, other currencies that would be, closer to the dollar.
Just real quick, talking about the different tiers of children and favorites, I am curious from your perspective, the Bank of Canada tomorrow, the decision that used to be a non-starter that now is somewhat a forward indicator for where the U.S. will go. What are you looking for?
Yeah, I think Canada's going to be really interesting. I think it's more about the trading rather than the Bank of Canada providing any impulse for the rest of the world. Again, what's clear is the data's been actually pretty good. We tend to look at the employment numbers as a bit of it's about a Monte Carlo simulation. It's a bit of a random number generator, but the trend in it's been solid and core inflation remains really sticky and it came in ahead of expectation. So our view is that like the Bank of Canada still has the ability to hike rates and be more neutral and suggest that they could still hike and they still might go on the sidelines. So that uncertainty is what can be very powerful for currencies. And so the way that we're trying to trade this is we're looking at the RBNZ. So what we're trying to do is sell New Zealand by Canada, largely because we're looking for a weak inflation number out of New Zealand this week. And then what you could have is essentially this recalibration where RBNZ is the one central bank that goes from 75 down to 50. Bank of Canada is, again, going up 25, but the market thinks they could be on hold. So the rate of change is, again, the key angle here, that one goes down, one's kind of stepping up. The Bank of Canada gets kind of exciting this week relative.
Yeah, I was going to say, we got to get you back here to talk Bank of Canada. It's heating up out there. David Dodge, the wonderful former governor, with some real criticisms of what's going on north of the border as well. I think we learned a lot about the pile of bricks in Chelsea. We did. I love the real estate listing. It's of unusual width. That's what they say. Ferro's looking at this property. It's near Arsenal. I don't know what that's about.
He's absolutely offset at this point.
It's the back kitchen of Thomas More from like a few years ago, but it's of unusual width.
Mark McCormick, thank you so much for being with us. We really appreciate it. FTD Securities.
Why don't you take us out? I'm looking at John sent me his real estate list. I'm looking at it.
You're looking at the real estate section. I'm actually just looking at some of the reactions to the earnings that we've been getting and wondering whether we're going to see this cost cutting continually. D.H. Horton actually disappointing for that pile of bricks.
Stay with us. This is Bloomberg.
I think people are banking too much on the Fed being more modest.
We do think that we're still a long way off from the Fed really signaling any sort of even pause.
We're very close to the end of the hiking cycle, but we don't necessarily think we should be pricing in cuts for the European Central Bank, the Bank of Japan. They're behind the Fed. We've only just got to neutral in Europe.
We don't know if those rate cuts are going to come in 2023. We think it could be a 2024 issue.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro in London, Lisa Abramowicz, and Tom Keene in New York. We welcome all of you. Earnings Central, I guess is what I'm going to call it. We'll dice through the earnings today. Microsoft this afternoon, 3M, J&J earlier, a different and new GE, I should say, as well. And Lisa, I want to go to what the sell side's going to do. Joe Feldman with Dana Telsey and the Telsey Advisory Group about an hour and 10 minutes ago took his price target down on Amazon from 140 down to 125, but he kept an outperform rating. That, to me, is sort of Feldman speaking about the sell side 90 days forward.
How much pessimism has already been baked into valuations? It's another way of saying that even with a disappointment, even with potentially less revenues or more margin compression, that's already baked in and then some. And that has been the argument for a lot of bulls out there.
I don't want to spend a lot of time on this. Verizon just out VZ, always trouble. They come in south of a 497 number. We're not going to go into that. There's too many other things to talk about. Big equity hours, so let's talk bonds here. I'm sorry, equities listen to bonds, and Lisa, bonds are speaking.
Well, bonds have actually been speaking to a disinflation, and they've been speaking to perhaps the Fed not having to go as far as people had previously thought, which is the reason why there is a sustainability in this belief that perhaps we're seeing the bottom, right? That all of the pessimism is baked in, which is the reason why you're getting a reignited push by the bulls, even in the face of some of the earnings that are coming out less than.
And the reignited push by the bulls is the bet of gloom, the short covering, but then it's what about after that? And to me, it's fascinating. Once the shorts are covered, do we once again go back down in the equity market? Up? Then we go back down. Then we go up.
This is the technical analysis of Tom Keene. Up
20.07 on the VIX. I mean, we're going like,
swaying up and down works really well on radio. This is the issue that people are looking at. I mean, Julian Emanuel walked in and I just said, my big question is, what about China reopening? Why is everyone talking about this as a positive and a purely positive rather than the demand for the commodities and sort of the inflationary pressure there? And that's a tension there. And there's a lot of pushback about how much demand could come back online to offset some of the pressure from higher commodity prices.
The bull case for China is scale. And I will never forget this. One of my offspring, cash flow, once said to me, Dad, you don't understand. There's 14 Pittsburghs in China. That's the most intelligent thing I've ever heard about China.
I'm learning a lot about your family, Tom. The tears of children, cash flow.
No, cash flow,
The Chinese, no, but it's a good point.
It's a good point. But the answer is there's 14 Pittsburghs in China. We don't understand the size of it.
Yeah, then which is the reason why the demand picture could be so constructive for the world economy.
VIX 20 is coming from a 22 level, a more constructive bull market over the last 5, 6, 8 days. We'll talk to Julian Emanuel about that in a moment. Futures at negative 10 for what it's worth. The yield space really going nowhere today, 3.50%. Lisa's going to give you the economic data to come in a brief. Inversion back on negative 72 basis points. And I'd also note oil simply resilient in a China scale kind of way. 88.37 on Brent crude. Lisa?
Yeah, and when does that become an issue in terms of demand destruction? We are not there yet, and that has been one theme. Just want to whip through what we're looking at today. 9:45 a.m. We get a read on the PMIs, both U.S. manufacturing and U.S. services, and the composite index for the month of January. We got that index, PMIs, out of Europe. They came in much better than expected at the beginning of the day. How much do we get a sort of sense that that's happening in the U.S., where you're already seeing services also turn south a bit? 1 p.m. we get the U.S. selling $42 billion of two-year notes. I'm watching this because of how much are people buying into this story that the Fed is not going to do as much as they say they're going to do. How much conviction do people have behind that bet? And then this is a huge earnings day, and we've been talking about what's been coming out: Verizon, 3M, J&J, Raytheon. Aftermarket, Microsoft really kicks off the tech earnings that we get. Microsoft has really underperformed. They've lost about 20% over the past 12 months. They're only up about 1% so far this year, even with some of the tech outperformance. How much do they give a bit of a boost to their outlook with some cloud computing?
What matters is what I think doesn't matter here. Dan Ives publishes on Twitter this morning at Wedbush, Microsoft matters.
It does matter.
Tune in this afternoon. We'll have coverage on radio and television for that. He was so good a number of days ago, we hauled Julian Emanuel back here because we didn't understand a word he said. Chief Equity and Quantitative Strategist, Evercore ISI. I want to go to the fact, folks, and we protect the copyright. I'm not going to send you out. Earnings edge. This is what Emmanuel has brought to Evercore ISI every day, the granular nature of where we are. And I want to know what disinflation is doing to your granular research note here early in earnings season.
Well, it's the revenue line is coming in. And that's really the story. And then the question is who are the companies, where are the pockets within sectors that can actually hold the bottom line, given the fact that the top line is decelerating because inflation is coming in.
You know, Zero Hedge every afternoon does a brilliant job with Bloomberg charts here, and one of them is a short squeeze chart. The last 2 days, big up equity market, we've had massive short squeeze. Then what? How do we get to the then what after we take out all the negative bets on the market?
So if you think about it, the last 2 months we are within this range in the S&P, 3,800 the low, 4,100 the high. And what it is this tug of war between the view, and rightly so, that inflation decelerating more rapidly than people expected. You know, Ed Hyman is looking for 2.5% inflation in 2023, which is very, very bullish on balance, except for the fact that part of the way that you get there is a recession. And when you think about the ISMs, you think about the leading economic indicators, you think about the money supply contracting, they're all telling you that that recession is going to happen.
But to the point of possibly seeing lower earnings and yet upgrading the forecast for the earnings target, as Tom was just talking about, how much is that gloom already priced in? A recession, a downturn in earnings, the forecasts that are coming in?
So the reason that the market has gotten off to as good a start as it has is you look at bottoms-up consensus, and it started the year at 230. Everyone knew that that was a fictitious number. Our number is 206, but I would suggest that actually in talking to our clients, the buy side is looking for more like 200. Now, part of the narrative around this short covering, among other things, is that that number could creep higher.
So we were talking about some of the cuts that we've seen, the announced cuts at technology companies. And this morning, as we get the slew of S&P companies reporting earnings, we're seeing a similar tone. Is that going to be the theme? Cutbacks. Is it steep enough to get you excited?
So look, cutbacks have actually rewarded stocks over these last several months. But there's a finite aspect to that. Because, you know, when you look at the way reports are coming in, there's only so much you can do to massage your bottom line if your top line's decelerating.
I want to talk to you about, not so much it's anathema to Julian Emanuel, but he's a fundamental guy working for Ed Hyman. And Ed Hyman has always believed in mixing in economics with fundamental analysis and technical analysis. Ralph Ancampora darkened the door yesterday, the technician, the giant of the CMT world, and he was heated. There was a bottom constructed in October. That's a lonely call right now. Was there a bottom constructed in October?
So what it really comes down to is if there's going to be a recession in the next 12 months, the answer is no, okay? If the recession is going to be both postponed because we have such an accumulated level of savings, because China's reopening, because the labor market has confounded everyone with its strength, that could have been a bottom, because down 27.5 at the low in October was the average of 100 years of non-recession bear markets.
Can you fold your notorious and lonely 6.1% China GDP call over to American equity optimism?
So, and actually the interesting thing is our China guy took his number down to 5.9 because the fourth quarter of 2022 is going to be better than expected, reported better than expected. And what it is, it's less a direct effect on the U.S. economy and more a psychological boost, because you look at the greatest names in corporate America, one of which is reporting next week in between the Fed and the unemployment report. And if those stocks do well because China's doing better, that's a wealth effect in the U.S.
Just real quick here, because this has been a theme over the past couple of days and weeks, is people are moving toward Europe as the outperformer this year. Do you buy that, with the China reopening disproportionately affecting that region?
We buy that. We buy that. And the interesting thing is, some people might say, well, the ECB is now the most hawkish central bank in the world. And that is probably true looking at the next 6 months. But the fact is that you are absolutely ridding Europe once and for all of the psychology of negative interest rates, and that is a massive positive for equities long term.
We have a big take story out this morning, folks. This is from our crack Federal Reserve team and bond team, Liz Capel-McCormick, writing with Janelle Marti as well. And this is outside your purview, but this is something Mr. Hyman's looking at, and he has debt ceiling experience. If we have a debt limit fight, as the headline goes, does it mean the end of QT? Does it radically adjust the Fed policy that your shop sees?
Well, it certainly ups the stakes with regard to what the chairman's going to say on February the 1st, because there's no question that he's going to be asked about that. And look, the part of the bull case of the last month is that there are cuts priced in the back half of the year, lots of cuts. Are those only going to be in response to a debt ceiling debacle, or are they a consequence of an economy that would be turning down naturally? It's really an open question.
Earnings season, earnings edge as well. What's your earning edge going to say when you write the last report for Q4?
It was a sloppy season, much more closer to the pre-pandemic normal. Numbers are coming down, but again, at the index level, not as important. It's all about picking stocks in this environment.
Julian Emanuel, thank you so much. Really, really appreciate that this morning. We're going to continue. There's lots going on here, including a tape deterioration. -7 has become -12. VIX not giving me much right now. I'm watching oil, $88.35 as well. John Ferro is in London. He will have further conversations for us from London and joining 124 sterling. Good morning. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Poland has formally requested Germany's permission to send its German-made Leopard tanks to Ukraine. That comes after weeks of pressuring Germany's Chancellor Olaf Scholz to drop his cautious approach to delivering the tanks. German law requires approval for the re-export of military equipment. Bloomberg's learned the U.S. Justice Department is set to sue Google as early as today. The case has to do with the search giant's dominance over the digital advertising market. Google controls most of the technology used to buy, sell, and serve online advertising. The company has argued that the market is a crowded and competitive one. In the UK, there's more evidence that the economy probably has slipped into a recession. British companies signal that output has dropped at the fastest pace since the start of the pandemic. Meanwhile, the government's budget deficit rose to a record. Soaring interest rates have jacked up the cost of debt service. In Half Moon Bay, California, police arrested the suspect in another mass shooting. 7 people were killed and 1 was wounded at 2 plant nurseries. The 67-year-old suspect was believed to have been a worker at one of the locations. Meanwhile, an 11th person has now died from the shooting at a dance hall in suburban Los Angeles. The suspect in that shooting killed himself. And General Electric forecast profit for 2023 that missed estimates. The slimmed-down manufacturer will strengthen its focus on aerospace at a time where there is sustained demand for air travel. This will be GE's first year without its healthcare division, which was spun off this month. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
It can't be negotiated over whether or not we're going to pay our bills. And not to do so would have devastating economic consequences. So I believe in the end we will find a way around this, and Congress will act to meet what I believe is a shared bipartisan responsibility to raise the debt ceiling.
Secretary of Treasury, who runs the Treasury of the United States and tells Mr. Biden what to do, particularly on economics and finance. Bloomberg surveillance is no different. Bramo tells me and John what to do on a daily basis. And she just laid down the law. It's time to talk the debt ceiling. We're going to get right to it. A quick market check. Futures negative 11, Dow futures negative 101. Dollar fractional, I'm going to call it. Euro 108.65. McCormick at TD Securities talking up a 115 euro for a cup of coffee at some point. Stronger euro.
That's basically the consensus right now. Go into Europe. And how much has that been the underinvested trade, the widowmaker for so many years that might actually make the bank this year?
Right now, on the debt ceiling, debt limit, this, that, and the other thing, and particularly with Liz Capel-McCormick and Janelle Marte's wonderful Bloomberg story today on what it does to Fed policy. Maybe this time is different. Anne-Marie Horton joins from Bloomberg, Washington, our chief debt correspondent. Is that right, Anne-Marie? Forget about 2011 and the memories of a really challenging time. How different is this time from the other times?
Well, I mean, the thing is, we actually don't know yet, right? A lot of what you're seeing right now is grandstanding. So we do not know yet. It is still early days. We obviously know that the Treasury is using these special accounting measures, and really this summer is when it's going to get difficult. The reason why everyone is so concerned that this could be different when it comes to the debt debate is because already this is a different Congress. Electing a speaker usually makes no news. This time, it was the main headline of the start of the 118th Congress because you have a group of rebels who are holding Speaker McCarthy accountable also for the backroom deals that he said he is going to work out. And if he doesn't do that, they now have a one motion to vacate. So this is why the politics have become very difficult. And you have to give it to both these sides because they're really drawing the battle lines right now. But then you have the Senate Republicans who they've raised the debt ceiling last time. And there was a little bit of back and forth, but there was no drama. And they're really saying hands off. This is going to be Speaker McCarthy, and this is going to be his debate with the White House and the Democrats. I'm going to lean on, Maya McGinnis here with Bloomberg. Joe Matthew, I think, does a great job on Sound On. But Anne-Marie Vallier, as usual, in his New Hampshire way, cuts to the chase. They're talking about, a ballet from 30 and 40, 50 years ago, generational. And as he says, and my quote, astonishingly, non-defense discretionary spending. One more time, take out the Pentagon. What we can really choose and decide in the white marble of Capitol Hill spending is 16% of outlays. Are they going to go after entitlements? Well, they might be saying they're going to go after entitlements. It depends really who in the Republican Party you're talking to and asking about this. But again, that can also show blowback from the population, from their constituents. This is what Senator Manchin was also talking about at Davos. He said, you'll scare the bejesus out of people when you say you're going after something like, say, Social Security. So it remains to be seen what exactly the Republicans want to cut. But they at least want to get in a room and have the conversation about spending. But to be clear, we have a debt because of both parties, right? There has been spending on both sides. There's been tax cuts on the Republican side. There's been spending on the Democrat side. And that is why we have the position we're in now.
And meanwhile, we see extraordinary measures being taken by the U.S. Treasury Department as they try to stave off some sort of default. Yet Secretary of the Treasury, Janet Yellen, is in Africa. Why?
Well, she's in Africa partially also not just to shore up alliances that this administration has in Africa. Biden had this Africa summit, but also this is really a geopolitical play. And she talked about this on her first trip, her first stop on the trip, which was Senegal. She talked about the fact that Russia is not helping the African economy and is actually making it worse. And then she also talked about how China is not a friendly and a good lender. So what you've seen from Russia and China, these two countries have really made inroads in Africa. And it's an interesting time for Secretary Yellen to be there also because South Africa at the moment had just had Sergei Lavrov invited, and now she's coming on the heels of that trip. So this is really a geopolitical play, and Africa is going to be incredibly important to the United States as they electrify their grid, right? Like, this is a place where China is able to get a lot of minerals and natural resources.
This is fascinating to me at a time when you speak with the business leaders of the United States and in Europe, and they're excited about the reopening of China, re-accelerating their push into there. And then you hear the U.S. saying that Chinese companies are helping Russia's efforts, that Chinese lenders aren't necessarily good actors in places like Africa and South America. How do you put these two stories together when you have the business community warming back up to the world's second biggest economy, and you have an administration that has bipartisan support to move in the other direction?
It's a very difficult conversation. I think it's a very difficult conversation lawmakers have with these businesses. It's a difficult conversation when a lot of those businesses want to also spend campaign and give campaign money to certain politicians. But the fact of the matter is what you do see in Washington is they want to make sure they are controlling that competition with China. And the business community, I know, really wants to go full on in. And it's difficult, and there's going to be very difficult conversation. At the same time, Secretary Yellen just met with Liu He in Zurich. She's now talking about how China is not a good actor when it comes to Africa. We also have this story out today from Peter Martin and Jenny Leonard talking about what the administration is confronting Beijing, and they want to make sure they are ascertaining this correctly. But what they are potentially seeing is that these Chinese companies are aiding Russia in non-lethal military and also economic aid. So this is really coming close to that sanctions line. And this is already worrying the administration because Beijing and Moscow said before the war they have a no-limits friendship. And this is really going to be Putin's last friend in terms of mightiness of what they can help in terms of any sort of aid.
Thanks so much. Greatly appreciated this morning. Emery Horton in Washington. We're talking about use of cash. We were talking with Margie Patel about that yesterday. Really expert on the linkage of bonds over to equities and who's giving you the best use of cash. 40,000 bodies, Houston, Texas, Halliburton, flat on their back for years in the energy shortfall that we had. And obviously better. Stock's gone like 25 to 40. I know you loaded the boat on that, Lisa. A dividend pop up 33%. And it's, again, that use of cash. Do you do it through dividend, share buyback, after options compensation to executives? And again, there's a dividend lift. You wonder if we'll see more of those.
Well, especially in the oil and the energy space in general. And that's something that we have seen, that's the dividend play very much in the fossil fuel producers that people are looking at now that are throwing off money, that don't know where to invest longer term. And you see this pretty much across the board.
ExxonMobil, a yield of 3.2%. 5-year net growth, which is back to the gloom of oil, 3% per year dividend growth doesn't get it done. And I just wonder how that metric's going to go. Let me give you one statistic here you're going to love, Lisa. I can bring it up on the Bloomberg terminal on the FA screen. They've only got $60 billion of free cash flow to decide what to do with.
It's such a tragedy for them. Honestly, though, this is really a story of Halliburton, yes, but also oil majors more broadly. And to me, when I hear about people being bullish on energy companies, energy stocks, regardless of where the price of oil necessarily goes, that's the reason why. It's because of this free cash flow that they're going to pay out through dividends.
Can I suggest that the British do this better than we do? We say 60
you
billion.
Suggest that every day.
No, we say 60 billion, and they say 60,000 million, which makes it much more like I can grasp 60,000 million.
Grasping it right now.
Much
in the air.
better.
60,000 million.
60.
Okay, so then do it
billion.
that way. 60,000 million.
British. Speaking of Britain, John Ferro in London. We'll get to that. Good morning. Bloomberg Surveillance in London, in New York, we welcome you. Mr. Ferro with some important conversations. And, of course, his 9 o'clock hour no doubt will be better than what you're seeing right now. Look for that. Lisa and me here, and we're going to get right to it because we're going to talk about Maury Harris and UBS there. Julian Emmanuel with us and Drew Mattis coming up. But I want to slow it down and talk about really the first blush I mean, big bank, JP Morgan, Bank of America, Apple, Amazon. That describes earnings on financial TV. There's other companies.
Which is the real nuts and bolts of what's going on. And
in America.
Is a motley picture. I'm going to keep going back to that. A motley picture of cost-cutting and dividend growth when you look at some of the energy companies and when you look across the board at others that are more traditional businesses, cost-cutting really in the front and before. Raytheon came in a little bit softer than expected with their expectations. If you take a look, they are splitting into 3 different units. How much, with your adapting and your adjusting, Tom, do you start to see more of this? The spin-offs, the readjustments, the closures of business, the job cuts. Raytheon shares up about 1.2%.
What Jamie Dimon said in one of his notes a couple years ago, the hard work of actually running a company.
But that's exactly right. How much do we start to see that, the rationalization of parts in a way that we hadn't during the era of free money? Halliburton shares up 0.8%, basically in line, a little bit higher than estimates when it comes to earnings. 3M, I think, is probably one of the most interesting earnings reports that we got this morning, because what you saw was both the foreign exchange headwind, which might turn to a tailwind, by the way, this year if you see that ongoing dollar weakness continue, but also cost cuts. And how much do we continue to see this? They are cutting costs across the board. Those shares lower by more than 5% due to a disappointing earnings forecast. And Verizon shares were disappointing, trailing the profit estimates of Wall Street estimates, and those shares down 2.7%.
Let's get some, we can do this, folks, on the Bloomberg terminal. Look at the terminal on Twitter is very good. And I've got it, you set up some presets and all that are secret. I don't know how they did it. I've got a guy that comes in and just helps me on this.
Yeah.
Like
while we're on air.
No, yeah, sometimes while we're on
air. Please,
Verizon, 10-year total return, 5% per year. Is that acceptable?
Well, is it acceptable in this era where you've got inflation that's higher than that, at least for the past couple of years? But I want to flip it on its head a little bit, because we're talking about Apple, and those results. How much is this tied to perhaps not as much demand for certain mobile phone services, broadband services? How much does this feed into the glut that we saw during the pandemic that's getting sort of...
Microsoft, same algorithm, 23.6% per year. Versus 5% at Verizon. Stock selection matters, as Julie and Emmanuel.
Verizon's also been losing market share to AT&T and T-Mobile.
This is a wonderful moment and a real hallmark for us after the pandemic to have Drew Mattis of MetLife join us. He's chief market strategist. But what's really wonderful, to give you a little bit of heritage of what we do here, Neil Duddick comes in as one example of a bona fide optimist. Drew Mattis is a bona fide optimist as well, in that every day he's looking at the American economic experiment as a glass half full. Who invented this? At UBS, long ago and far away, I think it was even called the Union Bank of Switzerland then, a guy named Maury Harris took a bunch of young Turks, and they won so many awards over so many years, Mattis had to get a structural foundation adjustment on his house. They were that good in their optimism when everybody else was gloomy. What did Maury Harris do? What was it like at UBS years ago? You and Julie and Emmanuel, you walked in and the Texas optimist said, let's go. What was it like working for Dr. Harris?
Well, it was a matter of following the data and see where the data leads you. And don't be quick to dismiss things that go against your narrative, right? And so that way, even if you're wrong, you're not wrong by much. And I think, if we look at the current environment today, the narrative of recession, as much as it's kind of the consensus call now, it's the one that makes the most sense.
You beat me up once. Sometimes he wears a bow tie, in case you know this.
That's
we're having a bow tie-a-thon at lunch or something, and you said high-frequency data matters. The mother of all high-frequency data now, his initial jobless claims, is a killer number. How do you interpret that?
Well, so that's the one that we're having difficulty explaining. But if you look at other series, some of which are quite good, ISM surveys or some
Ferro
of my favorites.
Is Ferro? John?
Yeah,
Ferro, thank you.
Both of them are now below 50. Now the service sector one's only been around since 98, but if you look at history, every time both of those are below 50, we're in a recession. So maybe the debate shouldn't be, are we going to have a recession? Maybe we actually should be having a debate, are we in a recession and something is holding up the labor market? And how long can that something hold the labor market up for?
But if this is the recession, isn't the optimism warranted because it's not that bad?
It is, but this could be the first step, right? I think what's happening is, there is a calendar in the corporate world, and it's not the earnings calendar necessarily, it's the planning calendar. So most large corporations plan out their hiring and headcount a year, 2 years, 3 years in advance, and every year they then adjust. And I think what's happening is the weakness really became more pronounced, and concerns about corporate margins became more pronounced in the fourth quarter, right in the middle of that planning process. So do you rapidly accelerate the planning process and perhaps make some mistakes? Or do you follow through on the planning process like you were planning on and execute at the beginning of the year? And I think that's the lag that we're going to see in the labor market.
So as someone who's responsible for MetLife's investments, how do you sort of go with your gut at a time when other people are going in the other direction? How do you execute your belief?
Well, so I'm not going with my gut. I'm going with the data. The ISM data is I think, compelling. Corporate margins or economy-wide margins are actually in decline. All right. And so when they begin to decline, what kind of decisions are starting to get made in the C-suites? If you look at CEO confidence in the economy 6 months out, it's at an all-time low. All-time, like history of the series, all-time low. Does that strike you as an environment where people are really going to be gearing up for the hiring story?
So you're not buying stocks?
Pan out? No, I mean, I think, if we look at kind of the most recent kind of relative value assessment we've done, treasuries, munis, resis, those all look good. Some parts of we like, we're very involved in privates, so private corporates and private ABS, et cetera. We like private ABS. And to be frank, cash is compelling for a lot of people right now, and it's complicating a lot of people's decision making because you probably have people who are on Wall Street making investment decisions who have never had cash as an alternative that actually yielded anything.
I want to go to the sweat at MetLife and every other responsible long-term investor. 2022 was original. Some people take it back to 1788 in the bond market. Certainly the 60-40 model was a train wreck. Will you have to switch your actuarial assumption based on the carnage of last year, or can a conservative pile of money heal over, say, 36 months?
So I think one of the advantages to working at a firm like ours is the
Giants tickets. Yeah.
It's the length of time that you have to consider when you're making an investment, right? Mm-hmm. And it naturally lends itself to not falling into the idea that this time is different, that things are sustainable when they're not. It can actually lead you to think like, hey, you know what, we have to be prepared for a low rate environment over a long period of time. But is this something that's really going to be the new world order? And the answer was, of course, no. Right. And so I think, investing over a long enough time horizon, it kind of smooths out what may seem like big cliffs and valleys in the financial world. They actually look a lot shallower or less impactful when you actually take a step back and look over a long enough horizon.
What's your GDP call now? Do you publish within Met or outside Met? Give us a window into, are you sub 1% real GDP growth, or can you be more constructive than that? Out a year, out 2 years, out 5 years?
So we're at 0.3 for the coming year. We expect a recession starting kind of end of the second quarter and kind of following in through the second half of the year. We expect the labor market will begin to weaken probably with the release of the February and March data in April and May.
Do you think that we're going to avoid some sort of financial accident that everyone was talking about last year?
I don't see the need for a financial accident to take place, but at the same point, as I said, you have a lot of people who have never seen cash as an alternative or as a realistic alternative to a lot of the investments you can make.
So what is your cash type of holding versus what it had been, say, 6 months ago? Have you been building it? Have you been accelerating it to some of the bigger ones you've seen?
Well, so, that's not something we actually do as an insurance company, right? You bring money in, you put it to work. And so we're very in the weeds in credit and making sure that we like the things that we're in and we're comfortable with the credit risk we're taking. But when we do a relative value assessment, you have to assess cash, and that assessment obviously has been improving because the rate of return on cash is improving.
In other lives, you were heated about the dots. Are the dots efficacious now, or should they be discarded by the Fed?
Well, if they are, what they're telling you is that they're going to be cutting rates well before inflation drops anywhere close to 2%. They're telling you that. That's not me. That's their dot plot is telling you that. And yet everyone assumes that they're not going to do anything. They're going to be able to sit for a really long period of time, even as the economy withers. And I don't think that's going to be the case.
Interesting. Drew Mattis, wonderful to see you. Really a pandemic sign for all of us at Bloomberg Surveillance. Somebody who's been with us for decades. Drew Mattis is with MetLife as well. What did we learn there?
The idea that cash is an alternative, perhaps not to put your money, but as a comparison versus equities, versus bonds, versus credit, and what that does in terms of putting a higher bar for taking risk.
I learned how many people listening and watching can encourage a 36-month perspective. I would say it's single digits. We have become addicted to, some people 3 days, some people 3 months. 9 months is long-term now. 18 months used to be long-term.
Okay, but people used to say...
Guys like MetLife are 3 years.
People used to say it was harder to predict short-term than long-term. And what I'm feeling is that it's getting a little bit harder to do longer-term than it used to be. And that people are less certain about whether we have a more protracted inflation or whether we get back down to something that we're used to. And that really is the argument on the long-term that's being had in a new way.
And I would suggest so much of that's coming out of the pandemic, as to see Drew Mattis in our studios today, another symbol of that. Let me do a data check. Futures at -11, the VIX 20.03. Not much going on here. Yield 3.5%. 10-year yield has been unchanged for a month.
I do want to just bring you this. A viewer writes in, tell TK that we don't do that anymore. 60,000 million is not a thing anymore in the UK.
I'm stuck back with, Windsor and Albert and Victoria.
60,000 million. That's like
the
I've never
rest
heard
of
that.
60,000 million. What else do we have? Oil, 88.67 from London with John Farrell, Kona Hake.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. New tensions between the U.S. and China. Bloomberg's learned the Biden administration has confronted Beijing over state-owned companies that may be helping Russia's war effort in Ukraine. The Biden team sees evidence of non-lethal aid being sent to the Kremlin. No one involved is commenting. In Finland, the foreign minister says the government may need to reconsider whether to move jointly with Sweden toward membership in NATO. That's after Turkey's President Recep Tayyip Erdogan raised new objections to Sweden. Finnish Foreign Minister Pekka Haavisto says the primary option is for the two countries to join together. In the UK, the Labour Party would more closely with the European Union as part of a reset of its foreign policy. Labour's shadow Foreign Secretary David Lammy will outline that plan today. Some polls suggest Labour could win the next general election. The FBI says that hacking groups linked to North Korea stole $100 million in cryptocurrency last year. According to investigators, the hackers targeted the U.S.-based blockchain specialist Harmony's Horizon Bridge. Now, Horizon is a software that allows crypto tokens to move between different blockchains. Those bridges became a target for hackers last year. And home builder D.R. Horton is reporting weaker than expected quarterly orders. Now, it's also warning that housing market pressures may persist into the key spring selling season. D.R. Horton has been stepping up incentives such as price cuts and mortgage rate buydowns. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
You focus on China, that's the right focus. It is the main destination of illicit exports by Iran. We've been in contact with the Chinese authorities and will continue to take steps to sanction those who are involved in the import of Iranian oil.
Mr. Malley, Robert Malley of the State Department, special envoy for Iran, and we're thrilled that he could speak with Bloomberg yesterday. I'm not going to waste a lot of time here because every minute is important for John Farrell in London. Futures at -11. Oil with a lift, getting near $90 a barrel, but there's much more, a richer discussion of commodities, including John Farrell's industry-leading analysis of copper. This is an important conversation this morning. In London, our John Ferro with Kona Hake of ED&F Man. John?
Hey, TK, thank you, buddy. As always, I want to talk about two metals, not just copper, but aluminum as well. Year to date, these two off to the races, absolutely flying. At the moment, year to date, copper up more than 11%, aluminum up more than 10%. We are just 3-4 weeks into this. Kona Hake joins us right now. Kona, let's talk about it. I want to start with this. It's a big picture question. It's an important one. How commodity intensive is this reopening going to be in China?
Well, that is actually the big question. I sense that right now it's very sentiment driven. The idea of China reopening is definitely going to lead to a lot of pent-up demand, just like it did when the US and Europe opened up after COVID. But in terms of actual manufacturing intensity, which requires a huge amounts of commodity imports, I feel like China's commodity imports are still pretty good. I mean, their stock levels are really quite high right now. So I think right now it's potentially the copper rally is running ahead of itself in anticipation of more to come. But I think we just have to be a little bit patient on that.
So when you hear Jeff Curry of Goldman say 11,500 this year, you're pushing back?
I think short term, I think we might have run ahead of ourselves. But I do agree that copper fundamentals are tight. Inventories are still pretty slim. The supply side still looks like there's a huge amount of capex that still is required. But I don't think we're at crunch time right now. But I think right now it's very sentiment driven. And I understand it's all thing China.
When you look at the marginal dollar increase of China GDP, has it become more or less commodity intensive over the last decade or so? Is that something that's declined?
Yes. I think China's reopening is significant, but it's going to be a different China. The structural changes that we're seeing in China, I mean, we've been talking a lot about the population decline, the fact that the property sector is no longer as hot as it was before, the manufacturing is slowed down, there's no longer that big impulse and push, you know, to go back to your point about intensity of consumption of copper. I just don't think it's going to be as strong as the 2010 rebound, for example.
Well, talk to me about where you do want to be. What bucket do I want to be in right now, preparing for the demand that's going to come? Where's that demand going to show up?
Oh, so I do think commodities are a good place, and I feel like copper and Ali have, you know, slightly gone ahead of themselves. I think crude oil is justified because, you know, right now, it's particularly ahead of the February 5th European ban on Russian products. I think China has a huge role to play there, so they're going to be importing more crude in order to meet that gap in terms of product exports, and they're doing that in a big way. I think mobility in China is just starting, and that's going to be, again, very oil intensive. So I like crude oil very much. I think to a certain extent ags as well. I think as they start, the Chinese go out and look in, you know, going back into restaurants and consuming what they couldn't maybe back in lockdown, I think that could be quite good for the beefs and therefore the feedstocks, which is the grains. Triple-digit
crude back on the table?
Just about. I think we might touch 100, but not necessarily go higher.
The reason I ask that question is because we're all trying to figure out how much of this we import to the United States, to Europe. Do we import higher prices from what's happening in China right now?
And that is the risk. So I think, yes, there's a potential that we see a little bit of an uptick in commodity prices, but for the reasons I mentioned before, I don't think we can sustain higher because the rest of the world is moving into recession. So we're just a little bit too China-centric right now. And I think we need to balance that out by the fact that the USA and Europe are slowing.
When you say the rest of the world's going into recession, who do you mean?
Okay, good question, because the idea is, at least the bond markets are telling us, that Europe and the USA are going into recession. Maybe a mild one, but it's still heading that way. The yield curves are definitely pointing to that. Obviously, don't look at the stock markets and think that everything's great and rosy. But I think if we are paying attention to PMIs, and maybe not today's European one, but US PMIs are going to come out later today, if those start showing continuous contraction, I think we are looking at a recession, and I think even if it's mild or not, it has to be taken into account, and that might have an offsetting balance to any China reopening.
The markets are playing a relative game. Are things better or worse than they were 3 months ago? Clearly they're better in Europe. One thing I don't think we've discussed enough is the fact that Europe is still projecting, 0%, 0.5% GDP growth for the year ahead. Why aren't we talking more about stagflation? Why is that word not being used a whole lot more?
Actually, if you talk to some hedge funds, they are talking about stagflation. And it's interesting because in a stagflationary environment, you want to stay long some commodities, but you also don't want to stay commodities that are economically dependent. So in that case, something like ags could do quite well because those are income inelastic. So no matter what happens to your economy, you need a certain level of agricultural foods. So some people like agriculture in their basket as a good hedge against stagflation.
So you'd prefer a long in soft commodities as opposed to a long in base metals?
Good one. Yes.
Interesting. That's the year ahead conviction call for you and the team. Conor Hack, thank you, a VDNF man. TK, some really nuanced stuff there about the year ahead, but I think the point that is most important to us and all our viewers, our listeners as well, is just how commodity intensive this reopening is going to be in China. You can see the sentiment story. Connor's talking about that. The metals are absolutely flying. Copper up more than 11% year to date. Aluminum up more than 10%. But is that just a sentiment story? Will it be backed up with real tangible demand, physical demand later this year?
I get the flows, John, are really, really critical. I just want to give you small understanding of that after what we saw from the president's trip to Mexico. Somebody handed me, John, my Tang from Puebla, Mexico, east of Mexico City. This is Mondelez, Mexico, and this is a tangible Tang example of the kind of commodity flows. I mean, I didn't want you to ask Kona Hake about Tang futures, but this is, again, the import-export dynamic, John.
Yeah, I'm not sure that's what she was talking about, Tom, and I think those sachets, because I was with you when that fan gave you them, they're from San Miguel.
San Miguel.
To be precise. San Miguel.
Okay, I'll go with that. Thank you. John
You
Farrell.
should check it out sometime.
Thank you so much. But this is underdone, folks, with a great Bloomberg Commodities team. We don't do enough on commodities to have Kona Hake with us in London, the land of commodities, as John looks at LME. Copper is really quite important. Futures -10, Dow futures -90 here as well. Lisa, I think we've got to digest this, and that you say to yourself, what could topple the apple cart? And as you've been very good about the ambiguity of a China opening, and if it cuts the wrong way, you get a super cycle commodity lift. No one really predicting that, but there it is. If you get it, that changes the story.
I was speaking with Nicolai Tangen last week, the CEO, the head of the $1.3 trillion sovereign wealth fund of Norway. And he basically was saying this is the worst case scenario for risk assets. China coming back online, reaccelerating inflation, leading to this stagflationary outcome that John was talking about, and nothing does well. And he's tied to the market, and he's got to just be vulnerable to it. But to me, that's fascinating, the sort of risk case scenario that people are not talking about.
You know, I'm hardwired that if you get commodities, industrial metals, copper, you know, aluminium, as John was mentioning, but if you get them to lift, that's always got to be good for the system. And I don't see anybody predicting out of control commodities, but are we even modeling in commodities as Ms. Hake was talking about?
It's a great question. There's also the political risk, and I do want to bring this up, especially because this headline just crossed about Ford in talks to sell a car plant in Germany to China's BYD. And I find this fascinating, especially after the potential layoffs that Ford was talking about or that was reported in Germany. How much do you start to see this? I mean, China increasing their presence with respect to the demand for German auto manufacturers at a time of increasing political tension. I mean, honestly, this has been one of the biggest conundrums that I've seen, where on the political side, pretty universally, people are talking about pulling back from the West and the East and creating a greater divergence. The businesses are going in the opposite direction.
What was your take on the labor dynamic and investment dynamic on your trip to Mercedes in Germany?
That they have to see China's sales. That actually is a key component of their overall business, one of the major businesses that they have, and they are going to cater to them. Do you know one detail? There are different kinds of cars that sell with Mercedes in China because most people have drivers who can buy a Mercedes.
Well,
and so they build a bigger back seat
they do.
for people that they sell. You know. Oh, is that right? In your Bentley?
You know. In the you accommodate as you can, but you know, seriously here, I look at what I mean. Is there we got to talk about this later. We got to run here to a break here to pay for the show. But the basic idea here, Lisa, is there a bipartisan anti-China feel in Europe like there is in America? We'll discuss that here. Brammo wants to go there. It's a motley day. Stay with us. This is Bloomberg. Good morning.
we're very much in this steady and significant policy narrative.
We've seen a disconnect, right, between market expectations and the Fed's hawkish announcements.
We think inflation is going to continue to trend lower. We think as time progresses, we will see those Fed rate cuts.
25 basis point increase, and that will somehow cause no recession to occur. So I think people are being too optimistic about that.
I think the Fed's goal this year is to be boring, and I think they're on track for it.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Welcome back. This is Bloomberg Surveillance on Bloomberg Radio and Bloomberg Television. The earnings parade ramping up. Tom Keene, Jonathan Ferro in London. I'm Lisa Abramowicz, and the rubber is literally meeting the road, I would say, with actual earnings of what companies are doing from actual companies to understand what the economic picture for them is right now.
Yeah, Lisa knows the school I'm in. I'm in the school of James Dimon and Brian Moynihan, particularly Brian Moynihan, I'd say, at Bank of America, which is listen to American business. Dimon has a jewel in James Glassman and JP Morgan Commercial Banking, listening to American business. And what we've heard this morning is diminished revenue growth, normal, disinflation coming in, and then sector to sector, company to company, failed business model, the word you're using this morning from Motley Crue. The Motley scene that we're in, every earnings story is going to tell a story.
And it's going to be job cuts for some. It's going to be cost cuts in other ways. It's going to be what happened over at Raytheon, where you divide businesses and try to concentrate certain efforts. You have a host of different issues that are coming to the fore as companies are really challenged. And what does this say about the gloom that's priced in? What you're seeing is a motley picture on that front, too, with really differing kinds of price reactions.
Yeah, well, and it's not the time of Nikki Sixx. I mean, you know, playing bass for Motley Crue. It's a time of we're moving forward with a China reopening. And I'm going to throw this out there, something I think new for us, with a new globalization that was barely touched upon in Davos.
Well, this is, to me, the most important issue that we were talking last year about the divergence between the East and the West, this idea of, repopulating supply chains, of the, deglobalization. That's not what's happening. And we are seeing that time and time again from one company after another, perhaps in the margins, but not very quickly. So what does that say in terms of where business revenues are going to get derived from and how important China's reopening will be?
And what's important here is it wraps around tech earnings, with Microsoft leading up this afternoon on to the end of the month, even after the Fed meeting. Some of the big names come in, like Netflix before, like Microsoft today, and all of that wrapped around the commodity dynamic that John Farrell just spoke about with Kona Hake.
How much will the China coming back online cause demand for oil prices, for commodities more broadly, cause some sort of reignition of inflation? I mean, we really haven't talked about that all that much. Today, we are seeing a bit of a softer tone, but yesterday was telling in terms of the rally, even in the face of some negative.
2 days in a row. Come on, Friday, Monday, the quality of the rally was whoa.
I would agree, especially with some disappointing data, with the leading indicators coming in perhaps softer than expected. We see the S&P down 11.40.25, breaching, though, that 4,000 mark. Remember when people thought that was way off the mark? So, yes, down today by about 0.25%, but not much to write home from given the recent rally, even on the heels of negative news. The NASDAQ also lower. You could see that euro strength perhaps fading just a touch. But again, 108.60. Mark McCormick on earlier, Tom, talking up 115 for that euro, a real retracement of what we saw with dollar strength last year.
And then the boredom of the McCormick presentation was this idea of not about strong dollar, weak dollar, but just pause and churn. And maybe that provides stability for businesses to adapt to what Drew Mattis talked about, which is we're coming out of the pandemic, and what kind of normal are we going back to? To me, that's a huge theme of the first half of this year.
And the uncertainty of that. And the other theme that I see is really the euro strength and the European strength, and everyone piling into this story because the reopening of China, that's why he's there. The reopening of China, because it's, the strength of Europe. It's the reassertion of the European.
Talk yet?
Yeah, well, we'll get there. I do want to, though, question this narrative. At what point does a colder winter, does more demand for commodities really pressure a euro region that's facing a lot of potential headwinds? And I want to start there with Brian Nick, Chief Investment Strategist at Nuveen. Brian, do you pile on to this long Europe trade?
Not yet. We came into the year underweight, the Eurozone underweight non-U.S. developed assets in general.
We've obviously seen a pretty strong decline in the U.S. dollar, and a lot of that's been to the benefit of the Eurozone. But if we're just relying on the weather here, and I think what's going to be a very uncertain opening in China, our people on the ground there see a lot of economic activity currently, but with the Lunar New Year and with uncertainty about just how long that's going to last, a lot of the things that are holding up that European trade right now are, in our view, iffy. So we're not ready to go to neutral, let alone overweight on European assets just yet.
How is that being expressed? Is that sort of a long dollar call, or is that just hunkering down in U.S. assets and waiting for the recent turmoil to pass?
It's more of a where we're putting the assets instead. So we're talking about being more overweight U.S., which has not done well earlier this year, but with the tech trade doing better, that's going to tend to be better for U.S. equities, and then mostly just an overweight to fixed income generally. So we put more of our eggs in the fixed income basket. Starting at the end of last year, coming into this year, that trade's done well on a risk-adjusted basis. So we may have to revisit that, because right now we had been talking about bonds over stocks from a valuation perspective, but given the run we've seen in bonds, neutralizing that view may make more sense.
Brian Nick with us with the Naveen on radio and television. I do want to point out just as one ginormous move that we've seen, I think underreported in financial media, natural gas NG1, the core U.S. contract, down 63% from the August angst that we had last summer. Brian, Nuveen owns the absolute high ground on muni bonds and fixed income, careful management of fixed income investments forward. How does your world change now that money costs something? How does your world change that LIBOR's up and we've got a legitimate risk-free rate?
For the muni market, the number one concern we have, the thing we point out to clients, is that there's going to be less issuance, because you have a lot of states and localities that are sort of flush with cash. They were borrowing money, like to your point, when it didn't cost much, but now with interest rates higher, you're going to have a lot of these areas that are more reluctant to borrow, and issuance is going to be constrained. We think it's going to be positive for holders of municipal bonds. It does make the market a little bit less certain in terms of liquidity. There just isn't as much paper out there, and we think that issuance is going to stay constrained for a while. On the flip side of that, though, as long as you have interest rates moving up, you had a reluctance on the part of retail investors to engage in the asset class. What I think you start to see now is, with rates falling, more retail investors getting in, because they feel like the playground's a little safer now.
Brian Nick, I'm going to say 40, if not 45 years ago, I was shaving one day a week. It was the last time the Cubs won. Brian, I had Sir John Templeton say there will be a shortage of bonds, away from government, full faith and credit. In municipals, in investment grade, will there be a shortage of bonds?
We don't see an outright shortage at this point. There's still a lot of this paper out there. We know that the Fed is undertaking quantitative tightening. They're certainly keeping an eye on this. I think there's going to be a moment here between when the Fed stops hiking and when they start cutting, that they're going to be stopping that quantitative tightening program. So that could also be a liquidity adding measure if they stop earlier than the markets are looking for. So we don't see the shortage just yet. And also, we're in a different environment than we were just after the financial crisis, when there was a genuine shortage of high quality paper because everybody was hunkering down. If we feel like the environment's going to stay a bit better this year, there's going to be not as much of a demand for that safe, ultra safe investment, government bonds, longer duration, higher quality municipal bonds, the things that people really flock to when it looks like the macro scenario is falling apart.
There's a story on the Bloomberg this morning that Tom was talking about earlier that caught my attention as well, by Liz Kappa-McCormick and Janelle Marte, about how potentially quantitative tightening might be ended early because of the debt limit debate, because of the disruptions sort of foisted upon the market from that whole drama. Do you see that as a likelihood?
I wouldn't call it a likelihood yet. I'd call it a possibility. I think the Fed wants to stay as far away from this debate as possible. I think Secretary Yellen did the Fed a favor by disavowing the platinum coin, the $1 trillion coin possibility, because that would entail the Fed's acquiescence, at least, to that process. I think the Fed doesn't want quantitative tightening to be tied really in any way to the debt ceiling debate, but also not really to sort of the ongoing monetary policy conversation. They've always sort of kept this sort of at a higher level. Balance sheet maintenance they see as more of almost a secular issue as opposed to cyclical. They want rate cuts to be the focus, but there's no question that they have a window between stopping the rate cuts, which we think is going to be sometime later this spring, and stopping the rate hikes and starting the rate cuts, and that's the logical time to end QT. So that may come sooner than later, especially if we're kind of hit with that debt ceiling debate right in the middle of the summer.
Brian Nick, very quickly here, what does a 10-year real yield do? The inflation-adjusted yield, so important to finance. What's it do this year?
So I think you have a combination of continued disinflation, but that's largely been already priced into the TIPS market. So if things stay as they are, we see nominal rates falling somewhat, which would be a somewhat lower real 10-year rate as markets are looking forward into a period of rate cuts in 24, as opposed to a mix of rate hikes, pauses, and then eventually rate hikes in rate cuts in 2023. So I think we end the year lower, but not a lot lower, because we don't see that economic collapse recession scenario.
Brian, Nick, thank you so much. I learned a lot there with Nuveen, of course, venerable in muni bonds as well. Lisa, what's so important there to me is the idea that we're hearing from Mark McCormick at TD and from Mr. Nick at Nuveen. It's just real simple. Is maybe the path boredom, where everybody gets to calm down instead of the ginormous not carnage, but the ginormous volatilities that we saw, set of volatilities that we saw in 2022.
Yeah, some people saying that even if some of the bond yields that are really settling out at a higher level than they were a year ago, even if they just settle out, that would be enough for people to go back to capital markets to raise money, to invest, to have conviction. That volatility in the benchmark bond yields really causing some of the turmoil in risk assets last year. It's when people, I want to just point out one thing. 3M, we were talking about how they had disappointing earnings and how they were going to be doing cost cutting. They say they plan to cut about 2,500 manufacturing jobs. So again, it's spreading on the margins away from just technology companies to also, you know, real industrial behemoths that have to rationalize their size in a new era.
A real benchmark. David Rosenberg out of Toronto writing. He looks at leading economic indicators, which we saw. David Rosenberg saying recession, quote, is a lock.
Well, and this is what we heard early from Drew Mattis. The question is it really priced in a lot of stocks?
And I would go to something that we don't talk enough about is what kind of recession is it?
Yeah, it's fair.
I would suggest it's a recession for a large but finite part of America, and there's a whole part of America that will just slip by, as they always do. John Ferro in conversation with Caleb Pickering. This is Must Watch, Must Listen with Berenberg in London next. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Poland has formally requested Germany's permission to send its German-made Leopard tanks to Ukraine. This comes after weeks of pressuring Germany's Chancellor Olaf Scholz to drop his cautious approach to delivering the tanks. German law requires approval for the re-export of military equipment. Bloomberg's learned the U.S. Justice Department is set to sue Google as early as today. The case has to do with the search giant's dominance over the digital advertising market. Google controls most of the technology used to buy, sell, and serve online advertising. The company has argued that the market is a crowded and competitive one. In the UK, there's more evidence that the economy probably has slipped into a recession. British companies signal that output has dropped at the fastest pace since the start of the pandemic. Meanwhile, the government's budget deficit rose to a record. Soaring interest rates have jacked up the cost of debt service. Verizon came out with a profit outlook that missed estimates. The largest U.S. wireless carrier's free phone promotions to lure customers are taking a toll on margins. Verizon has been losing market share to AT&T and T-Mobile. And Johnson & Johnson is forecasting stronger earnings for 2023 than expected. That comes after a year in which the pharma division was hurt by falling demand for its unpopular COVID vaccine. J&J will rely on other drugs this year to drive growth. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
We think China's reopening is good for China. It's going to be very good for the Chinese stock market. We're bullish there, but it's not going to necessarily drive revenue and earnings growth in the U.S. And that's what I was saying earlier. You know, China basically is 3% of the S&P 500 revenues. So, you know, even if it is a faster reopening, it's not going to move the needle in the short term.
Mike Wilson, arguably strategist of the year last year in the equity space. He is with a shop called Morgan Stanley. There are the nuance, the distinctions of China in the United States. We're going to get to John Ferro right now, Lisa Abramowicz and Tom Keene in New York. But I want to make a note here of the world-class Bloomberg News crypto coverage. Emily Nicole is in London. Lisa, she's a religion major, which makes her perfect to cover crypto. It's just perfect. She has a story out, which I have no clue what she's writing about. It's about Binance, which I guess is the world of crypto now, and they're mixing collateral and funds of customers, including your kids, Lisa. They're in there somewhere. They're in that slot somewhere.
I think they're into the Roblox currency.
This is the adult pro view on crypto. I want to just draw that to everybody's attention.
The real issue is how far that really will go in terms of the fallout and the kinds of regulation or oversight of some of the collateral for people who are saying, and then for people who need to take their money out or want to take their money out of certain of these platforms.
We got 23,000 print on Bitcoin, which means we can go to John Ferro. He is in London with the always interesting Callum Pickering. Mr. Ferro.
I actually have to start with an apology, Tom, just quickly. I'm taking a lot of heat for this from the last segment. Aluminium, okay? Just aluminium.
Yes, I did.
Not aluminum. Tom, I think we did it back to front. I think you did the English version, I did the American version. We spent too much time together. TK, thank you.
Yeah, sure.
Callum Pickering with me now, senior economist at Berenberg. Callum, I don't want to start with that. I want to start with this from BNP Paribas in the last 24 hours. I'll read the quote out for you and I'll get your view on it. Soft landing has been the catchphrase for still young 23, but we think it will go out the window in the same fashion as transitory inflation did in 2022. That line right there, do you agree?
Well, I think there are risks to this scenario. I think the danger is in markets we start pricing in, I would call it la-la land, which is we have two risks to worry about. There's the huge global energy price shock, which so far actually, at least in Europe and the US, doesn't seem to be playing out quite as aggressively as markets might have thought, say, 6 months ago. But then there's the reaction to that, which is tight financial conditions from central banks. Remember, this energy shock hit tight labor markets and tight product markets coming out of COVID and triggered these second-round effects. And so the danger here is that we think, well, if the first risk is not so bad, central banks just cruise inflation to 2%. We don't really get anything severe when it comes to the recession and everything's going to be fine. History suggests central banks rarely get these kind of calls right. We already made a central bank mistake in 2021. The danger here is that we forget that central banks occasionally make these kind of mistakes and then land in a bit of a mess in the second half of the year.
What's the mistake potentially this year? Doing too little or doing too much?
I think probably doing too much is the bigger mistake. Monetary policy works with the lag, but the problem is once you've reacted late to inflationary pressure, it's very difficult as a central bank to justify pausing while you still have signs of inflation. And so a good example, take the latest mix of UK data, clear measures of economic activity weak through December and January, no question. But then you look at the November data for services inflation and December services inflation, you look at the wage data and it's still edging up. Now, the economist in me says these price data reflect things that were happening in the economy 3 to 6 months ago. And so the prices 3 to 6 months from now will reflect these weak measures of activity. So central banks should indeed pause. Whether or not you can do that with inflation with a 9 handle or an 8 handle in the US is.
Well, let's talk about the US situation. Tom mentioned it earlier this morning, 190,000 on jobless claims. What does that data tell you?
Well, again, labour market data react with a lag, underlying fundamentals. The reason why the Phillips curve was so appealing for a good 30 years as an economic policy model is because governments and central banks thought if we create some inflation, we'll have strong employment data. That still holds. We have a high inflationary environment. In nominal terms, economies are racing ahead. This gives us an illusion of strength, which encourages strong labour demand. I don't think we're heading here into a severe recession. I think business cycle dynamics are not late cycle. This is an early cycle economy. The Western world's an early cycle economy that's been intercepted by this big exogenous shock, and then central banks have reacted. But it's far too early to say that recessions won't happen as a general rule. I think actually all the pain is probably still to come.
What can you learn from corporate guidance? So we've got a couple of earnings reports this morning. I'll cherry pick two. D.R. Horton, as a home builder in the United States, purchase contracts the 3 months through December, down 38% from a year ago. I'll pick another one, 3M, job cuts, 2,500. I'm told there's a big China reopening. It's going to help manufacturing industrials. There's one cutting jobs. What do you read into these right now?
Well, that seems to be the effect of the tight financial conditions on economies rather than the initial energy shock. And this is, again, where we just have to consider the lags that we're dealing with. The energy price shock, which actually for the US, the UK, and even in Europe, where we've managed to get enough supply now, it's really a terms of trade shock rather than a supply shock. We get the energy we need, we just pay more for it. We see that immediately. There's not much of a lag between the high price and the impact on economic activity. But there is a lag between what central banks do and economic activity. And so it's not inconceivable that there's very unusual window where the first shock isn't as bad as expected, things look fine, but then we're just waiting for the monetary shock to come through. That's why the housing market data and the labour market data are important, because those are major transmission mechanisms for monetary policy. And that's where I think we fall into this trap of thinking economies are fine, central banks need to go a little bit further to cool inflation, but in fact, actually, we've just made the opposite mistake to what we made in 2021, which was then to ease too much. Now the risk is we tighten too much.
So are we pricing in what you call la-la land relative to what you expect later this year?
I think the risk is that we start to price in this la-la land situation. I don't think it's inconceivable, but it's conditional upon certain things happening. And the main thing is that central banks don't make a mistake. And the other thing that we just need to keep in mind is we are out of the great moderation world, where inflation was trending to the downside and central banks could make a one-sided bet that you just stabilize growth and trust that inflation will remain low. We're now in an inflationary environment, aging populations, deglobalization,
regime
more fiscal
shift.
activism, which means monetary policy is asymmetric in the opposite direction. We worry more about inflation risks than we worry about deflation risks. Or to put it another way, central banks now face a trade-off between growth and inflation. And remember, we wouldn't be worried about a recession now if central banks hadn't reacted. If we were happy to just accept the inflation risk from this oil and gas shock, then we would avoid a recession. But central banks say, actually, no, we're going to accept the growth risk. We'll put economies into recession to control inflation. And therefore, to the extent that this this gas shock is not hitting as hard as we thought because demand is stronger, that may mean that central banks say, well, if demand is stronger, we need to go further.
That's what we hear in Europe right now. Callum Pickering of Berenberg. Callum, it's more complicated than I think these markets let on in the early weeks of 2023. TK, are we pricing in la-la land relative to what some people expect later this year? That's one of the conversations we're having here in London.
John, Southampton, Newcastle, can you make it?
You had to squeeze that in, didn't you? Can we make that? Can we make that happen?
We can make it.
We can make it. Apparently we can make it.
Good. Okay, take the surveillance, the car and fill it with petrol and, show up for Southampton, Newcastle.
It's gotten downgraded from the jet stream to the vehicle.
Well, no, but in London you've got to do that because everybody's on strike. John, the strikes are for real, right?
The strikes really are for real, Tom. To see the ambulance workers join in from yesterday is kind of shocking to go through that, Tom. And it's got the support right now, but I want to be clear about this. There are people who support this until something goes wrong, if something happens personally to you and your family, and then you've got a very, very different opinion on those strikes taking place.
Yeah, Lisa, this is difficult on radio, but do you think Ferro's doing the Matt Miller beard? I mean, is this something he's going to come back and be
have
the
a beard?
bearded one?
I'm going to...
Well, let's get the camera up. Let me just, let me defend myself.
I'm going to say no way.
Just quickly. I get the feeling that Matt Miller paints his and colours his in.
He has a stylist doing that.
It's just like stubble. I just get the feeling that he gets some paint in the morning and paints on a beard.
We have to give him time to defend himself.
He's got a stylist there. They're from Blitzer and Company. John Ferro, thank you so much. In London as well. We'll continue through interesting European activity through the week. Please stay with us. This is Bloomberg. Good morning. Bloomberg Surveillance, Lisa Abramowicz and Tom Keene in New York, John Ferro in London. Futures, well, -7 earlier, and they're pretty much stasis here, -12 with the VIX 20.06 giving me nothing as well. What a conversation yesterday with Luke Tilley of Wilmington Trust with serious Philadelphia Fed credibility, working for the Philadelphia Fed with encyclopedic knowledge of the importance of Philadelphia to give us a diverse view of what businesses are doing. We're waiting here right now for the Philadelphia, it's a mouthful, Lisa, the Philadelphia Fed non-manufacturing activity index. I don't know if we're going to get this right here at 8:30, scheduled to come out, but it was a negative 17 number earlier, and we've seen some other tertiary regional data really be pretty grim recently.
How about the Empire manufacturing data that we got last week? That was pretty devastating. And this is the reason why some people are saying this is a recession. This is something that's really negative. You're not necessarily seeing that and how it's bleeding through into markets.
Why don't we move on for that? We don't have that statistic yet on the Bloomberg. We'll get it up. That sometimes happens with the regional data. S&P PMIs, we see at 9:45. I know John Farrell will have that from London with his good show coming up here in an hour. Right now, and well, you can pick this economist or that economist, this strategist or that strategist, but it helps to have a chief investment strategist and chief economist, this at Citi Global Wealth, who is truly expert at linking the earnings and profitability dynamics of American corporations into our greater American economy. Owning the high ground on that is Stephen Whiting, and he joins us right now. Stephen, I love in your research note how you say there are beats out there and there's a bang-up fourth quarter, but you're just not all on board the American recovery. How painful will those corporate earnings announcements be throughout the year?
Well, there's something to adjust to later. It looks so much in the analyst earnings estimates like the fourth quarter was the recession, and here we are sitting in the recovery. And it actually looks a little bit like that in financial markets. And it would be wonderful if that were really the truth, if we weren't just on the leading edge of a hit that we're going to have in profits. And of course, how markets traded last year are not anticipating this to be, some kind of profit nirvana. We don't have 20% declines without something. But if you really take a look at the estimates, they fall at a 15% annualized rate in the quarter past. This is like setting a hurdle that a toddler could leap over. Most companies by far are going to beat those estimates, but then they're putting all that promise of the future that the year will be a growth year for EPS in the out quarters. But as soon as the second calendar quarter, the April through June quarter, there's a substantial gain. Now, there's some complexities. When you beat your earnings estimates, it's easier to hit those later numbers because of the level they come in. But the idea that this is all behind us in the economy, I don't think that's true at all.
Then how do you participate? I'm going to assume that Citi Global Wealth Management is not enjoying being 185% in cash like the triple leveraged all cash fund. How do you participate? How do you participate if you're not all in cash?
Well, look, we've got to live with the ups and downs of equities markets, and we've had 3 rallies in excess of 10% since the Fed started tightening. The real rally, the turning point for the economy, the beginning of a new recovery is likely to begin this year. 2024 could be a stronger year for the economy. Do we think that we should already be discounting this recovery? No. So we are playing it safer. Again, our largest overweights are in firms that are the most consistent dividend growers, in pharmaceutical shares that have low cyclicality. I think this very near-term period, especially before we see the January employment report and we probably see the Fed deliver a hawkish 25, is probably going to be a period where we're going to have to settle back a bit. And again, that does not tell us to time the market and be all out of equities, but we're okay with a short covering rally and low quality shares and just missing that for the near term.
Stephen, how much would you lean into oil majors in particular because of that dividend story, that share buyback story, and not necessarily a call on commodity prices?
It's a full weighting despite a poor cyclical backdrop. And we think that a lot of industrial and materials companies are going to see earnings downward revisions, are going to see weaker activity this year. I would say, though, that petroleum generally is pretty well positioned for a weak period for the world economy. The downside may be $70 in the Brent price in what will be probably a mild global recession or something that we might call that. Literally, the U.S. economy is going to have some significant job losses. We don't believe that you have sales declines without real job declines. We're not just talking about job openings. But even with that said, OPEC has cut production early. supply sources around the world are recovering slowly. So I think this is not going to be a particularly bad cycle for energy.
Meanwhile, you mentioned the Fed, and we have been steering clear of the Fed because they are in the quiet period ahead of next week. But there is this question inherent in a strengthening financial conditions index, a lesser negative, actually a positive that Tom's been citing as you see the stocks rally and as you see bonds rally. At what point does this push the Fed to go further, to do more than people currently expect, simply because this really does kind of make it more difficult for them?
Well, look, I think the Fed can't entirely ignore the fact that real data, 2 months of decline in industrial production, 2 months of decline in retail sales, 2 months of a decline in total hours worked, and all of that survey data that you mentioned are softening. Plus, we are seeing a deceleration in inflation. That's for real here. We have a decline in money supply. Yet, the Fed is not going to be satisfied. And unfortunately, I think that is their mistake, as you heard from an earlier guest, that the reality is that there's still pipeline effects on the economy that are coming. The problem for markets is that they can't ignore the slowdown in the economy that will change the Fed's view. And the Fed is in all likelihood going to try to weigh against the easing in financial conditions. Will they do that by tightening more and harming the labor market even more? They probably won't, but they're going to leave it to markets to sort this out. And there can be certainly more corrections ahead simply because of that mismatch.
That's a critical distinction, Steve Whiting. If they're going to, quote unquote, leave markets to sort it out, at the end of the day, do markets tell the Fed what to do with its understood asymmetries?
When I think about the message at the long end of the bond market, the Treasury market is saying that the Fed is already at an unsustainable funds rate, particularly now that they shrank their balance sheet $450 billion. They'll continue to lend less to the bond market. That yield curve steepening that they predicted on QT didn't happen again. So I think that ultimately the Fed is going to get this forecast. But again, it is predicated on the notion that our labor markets, that demand for labor is going to fall now that we have sky-high inventories and massive declines in home sales to reckon with in terms of labor markets. So the Fed will get the message of markets. I believe the longer-term bond market is telling the Fed the right message. I just do think that they're going to say, like they said in the minutes, that if markets have misjudged their reaction function and they're going to ease here quickly, that's not what they're going to do. I wish they would pause, but they're not going to.
And Lisa, you dovetail that with what Andrew Hollenhorst said the other day of, we go up 25, their new call from 50, et cetera, but then you get to a level, and to Mr. Whiting's comments, they stay there.
Which is the reason why some people are leaning into the long end, because they do believe that it will restrict growth. They do believe that the Fed will induce something that's more significant. Stephen, how much are you using longer-term treasuries, longer-term sovereign debt as a ballast in a really uncertain time?
Well, we are. We're overweight long-term treasuries, underweight other markets like Japan, for example, again, because we believe the correlation between stocks and long-term treasuries, equities and long-term treasuries, will break down and it'll be negatively correlated again. Portfolios will work with, barbells of high risk and low risk. At the same time, though, it's the front end of the curve and the belly of the curve that's offering real yield. So we have larger overweights there. And again, this is not to be negative in the long run. We can't be too cute about when markets can recover, but we're just not going to load up on a lot of cyclical risk. Interest rate risk, we think, is peaked in markets. So we don't have to worry about long bond yields going to 6 or 7. But we do think that there's a price to pay to keep 10-year Treasury notes at 3.5.
Stephen, before we let you go, do you care about the debt ceiling debate?
I think it's highly likely to be resolved. And I think that the debate over the House Speaker role, again, probably overstates the amount of risk. There are multiple ways to address this. There are, again, some ways in which we can cause a disruptive period. Again, losing the House Speaker role, not preparing in advance sufficiently for this. So it can be a market concern. I doubt that it rises to 2011 levels of worry again.
Stephen Whiting, thank you so much. A complete analysis there, and particularly linking in earnings in corporate America into the greater American economy. He is with Citigroup as well. You know, Lisa, I look at this and it just simply comes down to the original time we're in, which is a pandemic. And as Drew Mattis was very good about, okay, pandemic, in some ways, in clumsy ways, we're out of pandemic, back to whatever normal is. I have no idea where we are in that continuum after listening to someone like Steve Whiting.
One thing that Stephen was talking about is the layoffs, and he thinks that they're going to be more deeper than a lot of people think that they're going to be. And we saw on the margins, it's spreading beyond big tech today. And I really do think that I do take a signal from 3M and what they're talking about on the margins. So the question is, are they going to maintain this as a marginal transition as they try to preserve most of their employees, or do you start to see some of the deeper cuts that Stephen was talking about?
I think it's simple. You go to the Bloomberg screen, you go DES, you figure out the head count, and you take a percent that you have. And anything within 2 or 3% is completely normal. 4% is where you begin the debate. And what we're seeing in tech, which is much higher percentages to a great extent, particularly among zombie-like non-profitable companies, that's maybe not what we're going to see in the 3M world, the Steve Whiting world, where maybe their percent will be a little bit lower.
Yeah, perhaps. But Julian Emanuel said, though, if you're seeing lower revenues, you can't cut your way out of that.
Yeah, that's that's where I am with disinflation. You get lower revenues. I think that's how it works. What I know is what works is futures deteriorate negative 21 with a VIX elevated 20.19. Stay with us on radio, on television. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. New tensions between the U.S. and China. Bloomberg's learned the Biden administration has confronted Beijing over state-owned companies that may be helping Russia's war effort in Ukraine. The Biden team sees evidence of non-lethal aid being sent to the Kremlin. No one involved, though, is commenting. In Finland, the foreign minister says the government may need to reconsider whether to move jointly with Sweden toward membership in NATO. That's after Turkey's President Recep Tayyip Erdogan raised new objections to Sweden. Finnish Foreign Minister Pekka Haavisto says the primary option is for the two countries to join NATO together. In Germany, Bloomberg's learned the government expects Europe's economy to grow by 0.2 of a percentage point this year. That's instead of the contraction it had predicted in October. The updated forecast will be unveiled on Wednesday. In Half Moon Bay, California, police arrested the suspect in another mass shooting. 7 people were killed and 1 was wounded at 2 plant nurseries. The 67-year-old suspect was believed to have been a worker at one of the locations. Meanwhile, an 11th person has now died from the shooting at a dance hall in suburban Los Angeles. The suspect in that shooting killed himself. The CEO of Live Nation testifies today before a Senate committee about November's Taylor Swift ticket fiasco. Joe Berchtold will say the concert promoter learned valuable lessons when its Ticketmaster site crashed due to massive demand. The hearing will focus on competition in the live entertainment market. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
I have to stress October 13th, Tom. The Dow had an intraday price swing of 1,502 points. Since that October low to the December 13th high, the Dow is up about 21%. The S&P is up about 18%. So there's been a nice recovery. And since then, the market's been consolidating. I think we're making a bottom long-term in this bull market.
On charts, the giant, Ralph Ancampora there was CMT co-founder. Just can't say enough about the decades of experience he has. And I was shocked, Lisa, how Mr. Ancampora didn't mince words. He just picked the bottom.
He is positive.
I did not expect that.
He sees it to be sustainable.
And there it is, clarity on the technical side. We'll move forward on that here in the coming weeks and days as well. This is really important. We need to get a briefing, and it was very important that we find a guest least qualified. If you go to Microsoft's website, they're out with their soiree today. They talk about cloud, computers, apps, and gaming. And we said, well, Mandeep Singh can't do this, but then there's ChatGPT. Using ChatGPT this evening and into the early morning to get up to speed here, Mandeep Singh joins us as well. Have you used ChatGPT? Have you actually looked at it?
I have, and look, it is great for certain kind of use cases when you're looking for, let's say, a code snippet or something which is plug and play, and it's great because it gives you a concise answer. You don't have to get to multiple links.
You have real-world experience. You're not an expert on Microsoft, and yet there they go, diving into ChatGPT. What will they do with it? What's the Mandeep Singh guesstimate of what they'll do?
Well, they are thinking of it as a feature that can be part of all their products, whether it's Office, whether it's their Bing search engine, which has always
Bing is still around.
It's still around, and it's making $3 billion a quarter. So guess what? If they can fix Bing and take share from Google, then ChatGPT.
This is the heart of the matter, Lisa. Bing, which is mother of all dogs, makes $3 billion a quarter.
Well, it's because people who get personal computers, when they search it all, it automatically goes to Bing. So that's the reason why. Not necessarily because it's preferable to Google, but if they have ChatGPT, it could potentially boost that business. Does that give you a sense of where the revenues are going to be derived? Is it going to be in AI and AI-driven types of industries more than anything else for the tech companies you cover?
Yeah, look, I think for Microsoft, it's not just search. Also, their Office products can get smarter, So that's where you're going to see AI come into the fold for all sorts of things. Every software company right now is thinking about how do I add that intelligence layer, which is analytics, but also it can make that experience a lot better. So I think overall, it's a good thing for the industry.
I can't talk about this without feeling really uneasy, I've got to be honest. As a mother of children who are in school, where there's a debate of whether to use ChatGPT and the teachers are trying to figure out how to get around it, and it's adjusting how they give tests and essays in colleges, how much is there going to be pushback from this in a way that it disrupts the entire method of people evaluating each other and the use for humans?
I mean, look, even with social media, there are so many downsides of using social media, but we found a way to really make it viral, use it, integrate it in our day-to-day lives. I mean, we can argue whether it's for good or for bad, but there is an element of using social media. Same thing with ChatGPT. The fact that it can consume a lot of data, come up with intelligent answers, the processing power is used in a way where you couldn't do this before. And I think that's where you're going to uncover a lot of cases on the healthcare side. It could be huge in terms of processing large amount of data on the edge.
Well, that's with respect to software and hardware stories, but the technology of the Elon Musks of the world will be on full display on Wednesday. What are you expecting to see as the real world kind of comes to the fore, the revenge of the real economy that we've been talking about for so long?
Yeah, look, I think even for autonomous cars, if those have to become a reality, and there are a lot of doubters, and it will be, in a phased approach, but you can see the progress where we are going with this in terms of just making that car a lot more smarter. And that's where you're seeing a lot of custom chips. It can process real-time data. That's what I mean by processing at the edge. And a lot of companies have talked about it. The question is, how do you integrate it into a product that is used for a good purpose? Rather than plagiarism.
I don't want to embarrass you here with a private company, which I'm sure you're not up to speed on, but you are up to speed on Twitter, its culture rather, in the fabric of San Francisco. Lisa Mateo says they don't pay their rent, et cetera. There's no conference call, but where is Elon Musk 2 or 3 conference calls from now, say Labor Day of this year? Where is Twitter?
Well, I think Twitter right now is bleeding revenue. We saw, they lost almost 40% of their revenue. And that could be a good thing for the other digital ad companies that are also struggling. So right now we are going through that phase where ad pricing is down, and it's down a lot. And there is no hope because advertisers are pulling back. and you have Apple's privacy changes, that's hurting ad pricing. Well, guess what? Twitter is all brand ads. They have been bleeding market share, so that could be a positive for some.
He's getting very good. He didn't answer my question. Where is Elon Musk Labor Day with Twitter?
Well, I think
nobody knows, right?
Twitter needs somebody else to run the company. I don't know who that will be. He has to find somebody. He just can't manage both. And we're seeing that in the results so far.
We're talking about a host of different tech companies. Twitter, of course, is private, but Microsoft, Tesla, very much public. And we're going to get the earnings reports. What's baked in? How much pessimism, from your point of view, has been baked in? And how much are some of the layoffs, the cuts, the sort of rationalization really offset that?
Well, so estimates have come down mid-single digit for large tech, and I don't think it's pricing in that extreme scenario where second half is going to be disappointing. The consensus seems to be we'll have a second half recovery. Well, guess what? The fact that these companies are cutting now and they're cutting jobs and trying to preserve margins, that tells me it's not going to recover that quickly. But again, it will vary by sector, and we'll find out.
Do all these techie types find new jobs?
I think so, yes. I mean, given ChatGPT and all the other innovation on the auto side, these guys will be fine.
Okay.
They'll figure something out.
Mandeep Singh, thank you so much. Holistic there on all of technology. And I thought ChatGPT, he nailed Microsoft.
This is the big issue. How much can it really replace some of the search engines and make them that much more efficacious and create a real competitive kind of push against Google and the others? And, this is the upside of it. The downside is that your kids won't know how to write essays because they just use ChatGPT. Just saying.
Their schools are going to have to adapt. I mean, I think it's going to be like in the colleges, and you're going to see it right down through the system of secondary education. They're going to adapt at light speed.
Well, they're trying to adapt already, asking more personal questions, although, as Mandeep noted, probably ChatGPT could nail your personality better than you could on any given day. But whoa. But I will say that not only that, but you also have at colleges people who are asking students to write by hand again to get away from.
How quaint.
This.
I could go into my cursive rant, but we don't have time to do that here today. Futures deteriorate -23. I think they've done that 3 days in a row. And then, boom, the bid comes in.
And it comes in despite negative data, despite data that does indicate there's some sort of softening, which we did see, by the way, for the Philadelphia non-manufacturing segment. It did come in a little bit softer. Well, actually, it came in stronger, but it still did come in negative. But prices paid, just tanking. For this particular metric, which really highlights the disinflationary push that people are talking about.
Well, there's a number of features out there today. There's a research paper, I believe it's out of Barcelona today, looking at instantaneous inflation. I don't have it in front of me. I'm sorry, folks. And they're saying we're there right now, 2%.
Instantaneous inflation?
It's like
Is that
measuring
like
inflation at the moment. No, it's not like tang. It's like measuring inflation at the moment.
Yeah.
Big debate in economics. Adam Posen, thank you for bringing that to my attention. But the bottom line is, a la Dominique Constant-Mazzuo, he's saying we're there right now.
What happens if you do have that disinflation, but the volatility where you have inflationary bursts that come up as the frictions are sort of sustained? How does, a previously somnolent inflationary environment adjust to something that's a little bit more volatile?
Because I'm going to say this again, and this goes, do we have any Fed speakers today? Are we in quiet period?
It's quiet period ahead of the Fed
God
meeting.
For that.
Well, it's going to be all week, so.
Maybe we can have that all of 2023. But the point is that they're flying blind, they're flying original, and as Drew Mattis said today with MetLife, the idea here that we're coming out of a pandemic is this uncertainty that we're living with. No question about that.
We are readjusting to a new normal, but then it will be yet another new normal by next year, right? I mean, what does this mean?
2 days now, this Ferro and London thing, it sort of works, he's over there.
He's bringing us on-the-ground research.
On-the-ground research, and,
Fulham.
I think he'll be here in a moment with a 9 o'clock show, and I'll be on radio with Paul Sweeney. Stay with us. Futures deteriorate. -21. Good morning.